We all ready? Okay, look, we've got a really full webinar today. I think it's probably been one of my most, I won't say most exciting day of the year because we're just into the year, but one of the most exciting days probably in about 20 years. And I'm going to explain exactly why in this webinar. You're going to see exactly why. The markets are doing something I've not seen in 20 years. And 20 years ago, I wrote trading online, and at that time 20 years ago, that's when people were having the same level of euphoria I'm seeing in the markets. And you might think, well, euphoria, that's a bad thing, surely that means there are bubbles. Actually, we're not talking about trying to speculate every second of the day and miss the bigger picture. I'm talking about the bigger picture. I'm talking about Amazon in 1997. I'm talking about getting into Google in the early 2000s. I'm talking about that. I'm talking about seeing the bigger picture to make real wealth over a long period of time. We're not talking about get rich quick. We're not talking about short-term gains. So let's get on with it straight away. I can see you're all on this webinar. Let me know that you can see and hear me. There is an online poll. I want you to fill that in. I can see some of you already done it. The poll at the moment asks, will the FTSE be higher by the end of 2018? And I will try in my excitement not to speak too fast. Now, you got to remember, I don't care whether the markets go up or down. A trader knows how to profit from a rising market. That's simple. Buy low, sell high. But also, more importantly, if the markets fall, sell high, buy low. What I care about is trends. Can I get on the back of some of these trends and these coattails? How am I going to find them? What's the smart money saying? How do I get my insider tips from Goldman Sachs and Barclays and SocGen? And that's what I'm going to share with you all now as well. Okay. Richard, Nicholas, Themis, great. I'm going to be speaking to you all. There's three sort of red dots over there. You can do that to see me. I'm going to do one last message to everyone. We are live. Refresh if you cannot see me. Okay, and that's it. No more of the can't hear, are we live, or my microphone's not working, all of that kind of stuff. You will need a notebook for this because there's quite a few things I need you to write down. Right, let's start off with the first image, which is the main screen. I've got a whole bunch of research that I want to share with you and a bunch of exciting insights, some of which have really surprised me, actually, which doesn't often happen either. So these are the top trading insights I want to give you today. Okay, a bit of important information first and foremost. Look, anything that you see, what this important information really is saying is it comes down to this: risk capital. Okay, just in case you don't know what risk capital is, what we're talking about today, when we're talking about making money, when we're talking about making a consistent return, when we're talking about, and my target's going to be modest for you guys, it's just going to be 500 to 1,000 pounds or dollars a month. Okay, because I've said it before in my webinars, if you can make 500, you can make 1,000. If you can make 1,000, you can make 2,000. Because the nature of trading is it is a skill which is learnt. Traders are not born out of the womb. There's no reason why it should be in our DNA. I certainly wasn't. 20 years ago as a student, I was banging my head against a wall, knowing I wanted to do this, knowing I wanted the freedom, the funds. Okay. I wanted all of those things that trading gives and the fulfillment that it gives. But not knowing, okay, why am I in the 90% of losing traders? What is it? So given that it's a learned skill, which I learned and then proved it by going public with it, with all the books and winning competitions in the FT, I want to teach that. That's what gets me excited, the ability to teach that for other people to share in that excitement and that passion. But the one thing I've got to tell you, which is so important, and this is what, if you don't understand this, you will not make money. And if you make money, you'll lose it. Okay, is this the amount of money an individual is able to invest, the loss of which should not result in drastic change to their lifestyle? That's the definition of risk capital. We're only going to be trading and investing with risk capital. All right. We're not going to be trying to be all clever and remortgage the house and do something stupid like that. Okay, I want to make this clear. What are the things that people want to trade in 2018? Well, one of the things that I love when I polled people for this answer is the vast majority said anything as long as they have a strategy for profit. My job in this webinar is to get you that strategy for profit. I do not care whether we are trading the FTSE, and by the way, 69% of you think it'll be higher by the end of this year compared to 31%. All right, and I'm not here to argue the toss. the most important thing you've got to leave at the door is your ego. Do not sell yourself on a position or a view that, oh, I said it was going to be high, therefore it has to be. The first thing you need to leave is the ego of being right, because all we care about is making money. And we will trade anything as long as we can get a strategy for profit. When we go buy clothes for our family or food from Sainsbury's or wherever, they do not care where you made your money. They do not care whether you made it in Bitcoin, and I'll talk about cryptocurrencies in a second, whether you made it in UK stocks or European, nobody's interested in those anyway, US or Forex, okay? And that's therefore means, like anybody who's ever been wealthy in the history of the world of rich people, it is about maximizing our opportunities, all right, and having strategies. Strategies are not a secret. Strategies are things which people tell you in all walks of life, whether it's entrepreneurship or whether it's trading. My job is just to get those strategies to you. These are strategies which I've used myself to great effect and great acclaim over the last 20 odd years of trading. But I've got to tell you, I came from a state school in Leeds, and I used to make ends meet because I didn't have enough capital, didn't have a silver spoon in my mouth, used to make ends meet, not just from trading and investing, but even from cleaning toilets and side jobs like that. If I can do it, anybody can. And that's why I have the passion for it. And that's what gets me onto the TV programs, gives me the profile to have my own fund. But do not think I'm being arrogant when I tell you all of these success stories. Success isn't arrogance. What it's saying is I want other people to have the same passion, the same enthusiasms, and to get it right. What are we going to cover in this webinar? These are the things, my friends, we're going to cover. Okay, this is not a plug for my future book, because God knows when the Financial Times are going to publish this, because I've not finished writing it yet. Okay, what I am going to tell you is these things in this webinar. Okay, who's going to win? Well, actually, I'm going to show it's not about who's going to win, whether it's sterling, dollar, or Dow, or Bitcoin, or whatever. The currencies that I like and what the major banks are saying, how we're going to manage our risk and trade responsibly. Look at that. Hey, Alpesh, you're not going to tell us how to make $1 million in a week? No, because you know the best way to get rich quick is actually to be sensible, safe, and secure. My job is to show you how to drive safely at the fastest possible speed. Think of it like that. I'm like advanced driving instructor in this, okay? So you might think, why is he talking about risk protection, capital protection? Because actually that's what I've seen for myself and for other people has actually allowed them to make money, okay? We're going to look at some of the strategies and the tricks that the professionals and hedge fund managers use. I'm going to talk a bit about cryptos and volatility, not just them, but other currencies as well. And which of the trillion-dollar banks, the banks who manage trillions of dollars for their clients, are saying that the markets are going to collapse? What levels are they saying? At what points? And so on. And then I'm going to show you the trend following strategies that I use, how I dance around my investing with some trading, and that's how I maximize returns, because nobody wants low returns. Nobody wants the kind of returns that just simply buy and hold gives. We want to augment those, want to increase those. All of us want to make 500 to 1,000 a month, because that pays down the credit cards, it pays down the mortgage, the rent, allows us to shop, go on holiday without thinking about it, okay? And like I said, it's a scalable business, is trading. So if you can make that 1,000, you can make 2,000. So that's the enthusiasm, that's the passion, that's the excitement I want everybody to have for that reason, because without that excitement, you're just lost, okay? Excitement and passion gets you through to success in life in all things. And we're going to have a look at some of the Dow and the FTSE stuff, all right? What I'm also going to tell you, as I promised in the email I gave you, and the reason I'm telling you this agenda is because sometimes I go through a whole webinar, right at the end, somebody goes, oh, you didn't tell us all of that, Alpesh, and it's because they're not paying attention, okay? So I'm going to make sure you know I'm sticking by my promises. I'm going to also tell you why I sold all my UK holdings. Now, let me tell you really quickly why I did that. Since June the 24th, and those of you who followed me will know, June the 24th, the day after the EU Brexit referendum, I sold all my American holdings and bought British companies because the pound had fallen, so it was cheaper and allowed in dollar terms, and allowed me to buy more pounds than I could have done otherwise. And I bought banking and housing stocks. People who followed me know that from last year. And they've gone up about 75, 100% unleveraged, all right? Just buy and hold. And we're going to talk about trading in this webinar. But you know what? What's really annoyed me is that the UK markets continue to lag behind the American markets. Okay, so I've decided I'm selling all the UK ones, and especially because of the tax liberalization in the US. I am confident, and I'm accurate at this. I'm not going to bore you to death with my credentials, okay, but I'm accurate in this, that the Americans are creating, at least for 2018, and we worry about 2019 next year, at least for 2018, a bit of an over-exuberant bubble. Okay, and that's fine. I don't mind riding a bandwagon. I don't give a damn about riding a bandwagon, even if I think people are getting crazy on it, as long as I can buy low, sell high. Think of that mindset. It is about making money, okay? And we'll talk about how we get out of it and we don't fall off a cliff on it as well. So, and I'll show you which ones in the UK I'm still holding and which American ones I really like, okay, still. And because of that, and because of a tiny bit of leverage, you know, in case you're doing CFDs or spread bets, tiny bit of leverage, and by tiny, I just mean 2 to 1. I don't mean 100 to 1 or something. It's ridiculous. And we can talk about at the end, how do you get 2 to 1 leverage? Okay, I'm expecting at least 100% just from the buy and hold. I have bought today, and I was up till 4 a.m. last night on a bunch of exchanges because I don't want all my eggs in one basket. But in case you don't know, and you haven't been following me, I'm a huge fan of Ripple, okay? And it's not just because because Anderson Horowitz, one of the investors in the company which owns Ripple, they might think, who the hell are Anderson Horowitz? Let me tell you something. I was out in Silicon Valley. I know quite a bit about venture capital. Anderson Horowitz are the founders of the first investors in PayPal. What these American venture capitalists do, and by the way, they invested alongside Google Ventures in the Ripple company, is they don't just use this technology. They make sure they wipe out all the competition. They open the doors, they strike the deals, and that's why Santander used them, American Express used them. Now you might think, well, isn't it all a bit of a bubble? Yeah, you're right. Amazon going from $10 to $1,000, many times along that route had lots of bubbles. Okay, where it went overshot and then undershot, overshot. I'm talking about the longer term. All right, so I just want you to know this. We'll talk a bit more about this as well. And for this, over 1 to 2 years, I easily expect a 500% return, but it's all about risk capital. And we're going to discuss this in the webinar. So don't worry, we're going to discuss this as well. You'll have a lot of questions and answer them all. Then we're going to look at why am I then trend following on euro, sterling, US dollar? Well, it's to diversify. So my eggs aren't in one basket. And so I can get that expected return of 100%, because if I'm only getting 35% unleveraged from some good stock picks on buy and hold, obviously if I'm going to take the extra time, energy and effort to trade, then I want a bigger return. Okay, who says I'm allowed that kind of return? Well, my mentor, the global head of foreign exchange at Salomon Brothers 20 odd years ago when I met him, Bill Lipschutz, he tells me private investors should do it. He's the one who's taught me all of this. And that's what got me from banging my head to, well, after I interviewed him, the Financial Times said, we'll publish the whole book. Given that you've met him, he's that big, and he mentored me, changed my life, allowed me to become a hedge fund manager. So I'm just sharing all of the stuff which I really copied from someone else. I mean, nobody's ever, we all stand on the shoulders of giants, don't we? And finally, I'll explain why I've bought a triple leverage S&P ETF and why I expect, again, 100% return on that. In very simple terms, if you don't know what an exchange traded fund is, it's an index tracker. Why have I got triple leverage, 3 times leverage? Well, S&P allows me to get diversity, S&P 500. Why triple leverage? Because, as I said, this what we call fiscal loosening, these relaxation of taxation by the Americans should see the S&P rally at least 33% over the next 2 years. At any point, it does do that, and therefore 33 times 3, triple leverage. Remember, 33 times 3 gets me 99%, 100%. Now, I'm speaking really quickly. Okay, don't worry. This is just what I'm setting the agenda. This is the agenda. So that's the agenda, and this is the agenda. Okay, I'm just highlighting it all. Okay, and also right at the end, in the last 10 minutes, I'll show how I'm taking on 25 apprentices. Those of you who've been on my webinars before know that I do this. I take them in batches of 25 at a time, okay? So I have at any one time about 75 active apprentices. I'll show you how I can become one of my apprentices. This was an idea I stole from a billionaire called Donald Trump and another billionaire called Lord Sugar. If it's good enough for them, it's good enough for me. All right, let's start off with the stocks first. Let's start this webinar off with some of the stocks, my friend. Okay, this is the methodology I use. Don't worry, there's a lot of information on this screen. I will summarize it for you, because before I name you the stocks and tell you why I rate them so highly in the UK and why I've sold everything other than some of these, you need to know, well, how the hell did you pick them? Okay, the way I analyze my buy and hold British and American stocks is I look at value stocks, income stocks, and growth stocks. I look at a whole array. This is two too unclear on the screen, I know. So don't worry, I'm going to talk you through it. I look at a whole array of valuation metrics, income metrics such as dividend yield, and growth metrics such as revenue growth. What gives me the right to say I'm right and others are wrong, or one method's better than another? Well, when I was writing my Diary of an Internet Trader each week in the Financial Times, I had to do a lot of research because obviously you've got about 1 million readers in the FT who are the cleverest people in finance. You don't want to look stupid in front of them. So I take a lot of research out of the universities, and I came across a lot of American research because they have lots of data on the stock market, and they told they had researched what figures are important. And then what I do is work out, well, first of all, what valuation metrics are important, and then secondly, what weight should we give to them? For instance, is the price earnings ratio important? If it is it the only thing, or should it have a 50% weighting? Okay, so then I look at all the stocks, and then I look at about a portfolio of 14 positions. Now you might say, why 14? Why not 10? Why not 100 like your typical fund does? What we discovered is 14 positions is roughly, for buy and hold, roughly the right number that you're maximizing the marginal impact on your portfolio or the risk reduction. In other words, if you've got 100 stocks, then imagine all your money's divided between each one of those. So if one of them doubles, well, that's only 1 in 100, that's doubled. Whereas if you only got one stock, then you might have put too many eggs in one basket, obviously. So that benefit between too much risk and too little risk is about 14. There's a lot of mathematics which shows this. Obviously, it depends how much in lockstep they move with each other. So there's a lot of maths which goes into it. But for now, you don't care about all of that. What you care about is that when we did our analysis and worked out the valuation metrics, the income and the growth metrics, and scored it, these are the names, okay, bang up to date from the last 24 hours, which came about, okay? And these are the scorings out of 10. All right, this is the American companies. These are the largest American. And what I've got to tell you is, out of these, what I'm the biggest holder in. Now, some of you might say, well, that's not a bit of a surprise. Thanks, Alpesh. Only bloody told us the obvious ones that we would have worked out. Well, that's fine. But you know what's exciting at the minute? That Donald Trump has let all hell loose with tax cuts. We had a massive record-breaking rally last year. And starting this year, we've still got 8 out of 10 stock, 8 out of 10 on a scoring on this. I have never seen that. I have never seen that in 20 years, okay? I invented this software, 13 years ago, and been using this process for 20 odd years. And I've never seen, after a massive record-breaking rally, that there's still stocks showing on a scoring which includes valuation. Remember, it includes earnings. How much am I paying in the share price for profits? Now, look, I'm not selling you a fund. I'm not working for, mention a fund management company, Aberdeen Asset Management, saying, oh, the market's going to go up and up and up. I don't care whether it goes up or down, because we can make money from rising or falling markets. So I'm not trying to sell you into, oh, buy one of our long only funds. You know, it's a good time to be in the market. Those are ripoffs. Fund managers are ripoffs. I'm going to prove you later. They're idiots. Okay. What I'm going to show you is this. Personally, out of all of these, Alphabet, which owns Google, I own. All right. So that you know that. Kenneth, the answer to your question is yes, my friend. Apple, into that. Now you might say, why didn't you buy all of these? Well, I'm only going to pick 14 of these. Anyway, I don't care which of these you pick. Wynn Resorts, I like. Why? Well, it's a whole load of rich Chinese who are gambling at the moment. And as they get richer, they're gambling more. I own Microsoft. Now you might say, well, that's not bloody exciting, is it? Facebook, okay. Dollar Tree. Dollar Tree is the Poundland. You might think Poundland, aren't they in trouble in the UK? Poundland of America, okay? And guess what? You know why I like Dollar Tree? Because I also analyzed which stocks did well during the last credit crunch in case the market falls off a cliff. Well, Dollar Tree did rather well. There's a lot of poor people in America. Do not be thinking everybody's just sitting around getting rich. Actually, 90% of the people, by most definitions, are poor. Yeah, they find it difficult to meet their monthly bills. Dollar Tree is doing well because they're still making, those, and by poor, okay, it's unfair to say just because people go to a dollar store that they're necessarily poor. They might be astute, good savers. I love Poundland, by the way. My wife hates me for it. I absolutely love it because I'm not stupid. I want to overpay for something. Anyway, that's out there. Facebook, I think I mentioned already, but any of these are all 8 out of 10. These are the American stocks. Now, the chances are you're listening to me from the United Kingdom and not from America. Therefore, you're already seriously exposed to the British economy. So to diversify, I believe you should have global companies and American companies a part of that. Again, I'm not trying to sell you into my American brokerage or something. I don't have an American brokerage, all right? I'm just telling you what I like the hell of. When we did the same analysis We did the same value growth analysis, scored out of 10. Okay, we're going to come to Forex, we're going to come to trend following and trading and all those things in a second. I have never, ever, and this is just the 350 largest UK companies, okay, I have never seen so many stocks after a record-breaking year have a 9 out of 10. Okay, in about 20 years of doing this. Now you might say, well, isn't that a bubble? Well, the problem with it being a bubble is this looks at valuation. This looks at what's the valuation of these companies given their earnings. Okay, now you might disagree with me on some of this. We data mine this from accounts. The way we do this, I don't go out and meet the CEOs and the directors and all that rubbish, because I've done the research and worked out there are certain metrics which if you value on valuation growth and income, then there are certain ways of picking stocks which just outperforms every other UK fund manager. Okay, and over 13 years we've done that. Every single UK company fund manager. If you want to know the proof of that, which has been independently verified, I can give you that at the end of the webinar. You can look up the link and you can see, oh shit, Alpesh is right. Okay, but I'm not here to do a Alpesh Patel bragging session. What I'm here to do is to tell you which stocks I like and why I've not seen something like this for a while. Okay, and I think one of the reasons is, and what we're forgetting, is earnings. We're not looking at underlying profits. And if the companies keep on generating underlying profits a bit, now you might say, well, wait a minute, Alpesh, you got Barrett, you got Bellway, you got Crest Nicholson, you got Persimmon, you got quite a Redrow, Taylor Wimpey, you got quite a few construction and housing companies. Aren't you over exposed to one sector? Guys, the markets, no matter what, tend to be correlated anyway to some extent. I'm looking at bottom up. If you're really worried about having 4 housing companies, fine, divide your allocation by 4 and put a quarter into each. Okay, that's all. And then don't forget all the others. Now, I'm not going to bore you with, oh, well, I think Bruin Dolphin are doing well because the stock's going up and people are investing in blah, blah, blah. This is done on data analysis. The only thing to me that matters about a company is proof. I want to see their accounts, and let's hope their accounts aren't fraudulent, as they sometimes are. Let's assume they're not fraudulent accounts from these 350, out of the 350 largest British companies. And those accounts prove to me their ability to consistently make profits. But just because they made profits, how do I know it's not already in the price? Well, I then have to look at the valuation metrics and I have to weigh them and I have to know what's important based on the academic research which has been done. Anyway, without boring you in academia, these are the names, okay, that I love at the moment. Well, that's fine, Alpesh, but aren't we hearing a lot about the market going to crash? So even your good value stocks can fall because in the credit crunch, even the good ones don't. And you're absolutely right. Okay, but let's remember one thing else. Why is the market rising like crazy? No matter what happens, whether it's FBI directors resigning or Trump saying he's going to blow the whole planet up, the market doesn't care. So you might think, well, the market's wrong then. We should just short the hell out of it. Well, before we do that, we might want a bit of evidence that time is right to short it. So let's just keep looking at this. This is the S&P 500. This is going back all the way to 1930, okay? 1930. We have got one of the longest bull markets. And you knew it was a big bull market, but you didn't know how big it's been. It's been one of the biggest, longest bull markets ever. So what does that mean? Is it going to continue into 2018? For how long? And what do we do about protecting ourselves? First of all, what do we do to make money out of it? Okay, and how do we make sure we don't put all our eggs into one basket and just simply think, oh, I'll just go long the S&P index tracker 3 times leveraged? Okay, what do we do to protect ourselves? And what do we do in case it falls back? All right, in case it falls back, because we've got to look at all of those things. Rich people don't get rich by simply putting all their eggs in one basket, closing their eyes, and then going, la, 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 I'm not going to look at any other market information. So we need to protect at the same time. We need to get our information in. The information from the Bank of America Merrill Lynch, okay, is this. We're not extremely bullish, but yeah, we're over there. And I think that's a pretty good guesstimate. Okay, what Bank of America Merrill Lynch are telling their richest clients. Okay, so what's my take? What's my views? All right, let me tell you a few things which are making me mad at the moment. This notion that we have to pick either or. You know, when people go, oh, is it the Dow, is it FTSE, is it Bitcoin? What should we look? It is not either or. And this notion that, oh, well, there's a bubble in the market, there's a bubble in this. I like bubbles because they go up and up and up. My job is to get off before they fall off a cliff. Okay, and one of the reasons why, I'm going to talk a little bit about cryptos for 5 seconds. These cryptocurrencies like Bitcoin and Ethereum and Bitcoin Cash and Ripple, which is my favorite in case you hadn't worked it out before, okay, is they're relatively uncorrelated. This is a correlation table. I want assets. And somebody got a Nobel Prize for this in 1956. Okay, and I wrote about this in my Financial Times column. He got a Nobel Prize for working out, not about cryptocurrencies, but working out that the route to wealth, the real secret of why some people get rich and others don't, isn't just because they won the lottery or they gambled. Of course, those people get rich, but that's through luck. Forget the luck bit because you can't replicate it. The replicable way in which people got rich is they held assets which were not correlated to each other. Now you might think, what? Who thought that was the formula? Well, if the formula was bloody lying there on the envelope, on the back of every envelope, we'd all have done it. Okay. So when I get a new bunch of new assets, which are relatively uncorrelated to each other, like cryptocurrencies, I want to start looking at them in my universe of assets. And later on, I'll show you when I look at my screen and my universe of assets, like, for instance, euro, dollar, the DAX, which is the German index, as you know, Ripple, Apple, American stocks, sterling, FTSE index, Dow. When I look at this universe, if I can add 3 or 4 more, which are not correlated to each other, then I know I've got more opportunities. If I've got more opportunities to succeed and make money, then I'm naturally lowering my risk of getting it wrong because I've got more opportunity to pick a higher quality trade. So how are we going to do that? Well, we'll go into that in a second. But what annoys me is that people think it's either or, and they think bubbles are necessarily bad. Okay, they're bad if you close your eyes to them and don't jump off them. All right. We're also never going to gamble on single news items, like I said, like a bubble, and from over-opinionated morons saying, without looking at the facts. We are going to look at facts and hard data. I don't want you to trust me at all in this webinar. I want you to trust the sources I give you, okay? And if I say to you, the Bank of England has published a paper on the potential for using Ripple for settlements, okay, that's something which you can independently verify. You don't even have to trust my word for it. Okay. And I hate bad education. We're going to make sure in this webinar we don't do the bad old way of having lots of computer screens open, looking at, oh my God, looking at bar charts and Kagi charts and Japanese candlesticks and looking for some holy grail. Let me tell you now, people, there is no holy grail. Okay. No offense to the Christians. There is no holy grail. Okay. What there is a number of methods which work some of the time. So given that some things work some of the time, how are we going to make money? Because if no one thing works all the time and only some things work some of the time, how are we going to make money? That's the thing. And let me tell you, okay, let me tell you what we're going to do. We're going to make a few small improvements to your trading, which are going to have a huge impact. We're going to get you out of the 90% of losing traders. All right. And I'm afraid that's the case. 90% lose money. And we're going to show you what the 10% who do things right do. All right. So in this webinar, we're going to look at stop losses and how to make sure they're not too close or too far, and how we make sure they're out of the reach of market noise and volatility, whether it's a cryptocurrency or whether it's the DAX or the euro or the FTSE or the Dow or silver or gold or oil. Okay. But not so far as to lock up all of our money. All right, so that the stop loss never gets hit and we're just handcuffed into a losing position. And all we can think about is that losing position. And because of that losing position, we throw good money after bad and we even sell our profitable positions. Put your hands up if you've done that. Put your hands up if you've done that. Arif, I'll tell you also which platforms are best to use, which ones are free, which ones give you free live real-time data as well. So Arif, my friend, I'll tell you all of that. So much to cover. I'll do that as well. I will cover everything. I'll stay here till 4 in the morning if I have to answer every single question because I love this stuff. We're also going to show you how to make sure you get the trade size right. You know what the biggest problem and the reason 90% of traders lose, and I know this because I've worked with brokers. When you write in the Financial Times, guess what? All the brokers, they want to meet you. And when you speak to them, you go out for drinks, they let you know what their losing clients are doing. Because the brokers are bastards. They want the losing clients to lose. And over a drink, and I'm teetotal, so I'm always sober and remember everything they've said, they tell you, okay? All right? 90% losing traders trade too big. So we're going to have to work out a formula so that we risk the same capital on each trade. Okay, a little formula, which won't take us too long, and we can keep doing it. And when we do it long enough, it's a bit like driving. I'll give that analogy. We can just do it subconsciously. We can work out but that's the reason why 90% lose. You know what the worst thing is? And I've heard it time and again from people. They say, called it right on Amazon, called it right on Google, called it right, maybe even on Bellway and Persimmon. Okay. And they go, but you know what? I traded too big. It went down a little bit. I got spooked, so I sold it. got out too early, or I had some other losing positions. That's why I thought I'll take the profit on it, and therefore that's it. I saw the rest of it escape and go away. Don't get me wrong, my friends. I made the same mistake. Back in 1992, I think it was 92 or 91, I owned Next at 21 pence. Yeah, I made the same mistake. Put so much money in, and it was like about £5,000, which was, a quarter of all the money I had then. And that was borrowed from friends and family, by the way, for whom I was sort of running it and taking a fee for managing their capital. As I was just finished school, I just started uni. And I traded too big and I got a bit spooked. It went from, I think, 21 pence to about 30 pence. I thought, whoa, 50% return. Better get the hell out of this. Well, it's at £7 today, if you've noticed the news. So you know what I mean? You'd think, Alpesh, surely you can't trade too big. We're talking about making money. Surely making money means betting big. It's not. Okay. You can tell I'm being honest because I'm telling you, I'm asking you to trade smaller. I'm asking you to trade smaller. You might think that's just got... sorry, Nicholas, you're right. What am I saying? You're absolutely right on the numbers. At £7. Okay. Entry. We're going to look at, and this is one of the most important things. How do we make sure we don't get in too early? I know that's the mistake you've all had, isn't it? So we're going to look at trend following. We're going to look at the techniques, not the techniques Alpesh tells you, because he woke up one morning and had went up a Mount of Olives and spoke to God and got a revelation, like so many of these teachers apparently do. No. I'm going to just copy what hedge fund managers have taught me, and I'll prove to you they taught me it because it's published in the FT. Okay, so okay, he's not making it up. He's not pulling it out of his backside. Okay, and how do we make sure we don't get in too late? So we're going to piggyback on someone else's risk. If you think about it, it's the obvious way to do it. We're going to piggyback on somebody else taking the risk, a big bank, first moving the market. So we're never going to be able to get in at the bottom or out at the top. Guess what? If we don't bottom pick and top pick, we'll be in the same company as Bill Lipscott's global head of foreign exchange at Salomons, whose boss was Warren Buffett at the time. Okay, we'll be in the same company as Winton Capital. Write it down, Winton Capital. Look them up. They're in Hammersmith in the UK. They run $35 billion. They're my heroes, absolute heroes in the entire world. They do trend following. Okay, we're going to piggyback on somebody else moving the markets, and we get in later. And I'll even show you slides from that $35 billion hedge fund. So you don't have to trust me. You can trust the methods we're using by copying others. And it's what we copied into my fund. All I did, I'm not like Amazon, because I'm not $1 trillion business. I'm like the guy who copied Amazon, okay, and did fine. Did well enough. I wish I invented Amazon. I'm not that talented. I just copied what they did and did well enough. And that's good enough for me. Yeah, that's life. What can you do? All right. Profits, how do we make sure we don't take them too soon and we don't cap our profits? This whole notion of, what's your risk reward ratio? Well, that implies we're capping our profits. Why would you, if you struck oil, cap it? Okay, but it's not just that. So I'm appealing to your logic there. Let me appeal to proof. I'm going to show you how the biggest funds don't do that. They don't do that. If you strike oil, you double down on it. All right, you don't double down on your losing positions. You double down on your winning ones. So we're going to reinvest our profits. Okay, we're going to add to our winning positions, and write this down. Winners add to winners. All right, I didn't say it. Some of you might know who said it. Very famous hedge fund manager said it. Winners add to winners. And he also said losers add to losers. Write that down. It's the same in life as it is in trading. And I want you to write that down as well. Whatever's true about success in trading is true about success in life. All right, which is the other reason why only 10% of people are successful, really successful in life. Trades, how do we make sure we don't have too few? And that we don't have low quality trades. That's the biggest problem. Oh, but I've got too few trades. Yeah, but I get it right when I get it right and I make good money, but I only have one or two. Well, that's because you're too focused on just one or two instruments. You're not looking at a good window of opportunity, windows of opportunity giving you ample choice from foreign exchange to European stocks to British stocks to commodities to European stocks. If I haven't said that already, to cryptocurrencies with live real-time prices for free for life. Okay. Okay. So how do we make sure we get the biggest quality? And what we're looking to do, let me just give you some of the longer term picks. I did promise this in the email, so I want to make sure I deliver my promise. Sterling, US dollar, longer term, as you can see on this, and this is from 2017 when we got a buy signal. And by the way, the green arrow, whenever I show you this on the screen, it means we got a buy signal, momentum based trend following to go long. Okay. Now notice how how we'd had a sell there. Our long there didn't do anything. It was a bit of a loss there, wasn't it? Okay. Our short sell didn't last very long, did it? Okay. But this long, that's the longer term view. And I'll explain all of these arrows later on in this webinar. My point is this. That's our long view at the moment. For those who want a long view, guess what I like to do? That's a long view. We've got a long bias on that. Okay, that's clear and that's there. What I like to do is trade when I get the opportunity short. And I'll show you some of the live trades we've got going on at the moment in this and everything else. Okay, short. You know why? Because longer term, I'm making money as it rises. And shorter term, I'm effectively hedging by going short whenever I can. So how do you find those short-term opportunities? And anyway, how did you find those longer-term trends as well? Those are the questions which we will answer. That way, I'm greedy. I'm making money in the long term. I'm making money in the short term. I basically do not want to have a day or an hour or any period of time where I'm not making money, because that is my job. Okay, don't get me wrong. I mean, I'm not being arrogant. That is the job of a bloody fund manager, to be making money. It's not to be healing the sick and the infirm. It's to be making money. All right. So just so you know, that's why we like to do all time frames. I'll show you the shorter term time frames and how do we determine when to buy. How do we know when to double down on our position once we've got enough profits, and where do we put a stop loss so it doesn't get hit by market noise? Why we're not trying to bottom pick, why we let somebody else get a bit of the trend first, but when? Make sure we don't get in too early or too late. Okay. And just so you know, I've already banged on about bloody Ripple, haven't I? Listen, me telling you about Ripple isn't going to move its price. It's worth $122 billion, but I'm just letting you know, long-term view, bullish. Euro sterling, long-term view. This changed around 2015. Where are we? 2015 to being a long-term view. At the moment, we're sideways. We're neutral on euro sterling. Oh, well, thanks, Alpesh. So you just brought us here to give us no view. Well, that's still a view. We're neutral on it, but I'll show you how we're trading it. And which timeframes I like and why I love those timeframes that I'm going to be showing you, my friends, as well. One more thing as well, because you want to know this, is euro dollar, because everyone keeps asking about this. Okay, from last year, 2017, so a year ago, this has been and continues to be a long bias in the euro. Now you might think, what? Are you nuts? Why would you have a long bias in the euro with all Brexit and everything? Listen, we're following a trend. Okay, we double down longer term, but shorter term will be short euros as well. I'll show you the short euro trades. That way I'm making money on the long term and hedging. I'm protecting myself in the short term. So I'm protected as much as possible in the interim, and I'm making money with both hands or both fists. Okay, that's the ideal idea. And that's the perfect scenario. So how does this work in how does this work in reality? Okay, how does it work in reality? I'll come into. Okay, and can I just say, right, if I promise to give you great content, do I have your permission to take 10 minutes right at the end to tell you about technology my fund has invested in and how you can become my apprentice or one of my 25 apprentices? One of my partners. That's right at the end in the last 10 minutes, okay? I did one of these webinars once. I gave all this information from Goldman's and everything else and all these, and right at the end, I said this in the last 10 minutes, and this person went berserk. He went absolutely skits. So I just want people to know this, all right? So I'll do that right at the end. Now, let me tell you what timeframes I love, okay? What timeframes do I like? I am going to show you why I think as a process, my friends, thank you, Hitten, thank you, RPR, Kay, Patrick, Paul, everyone else, okay, my friends, thank you. I like us to be looking at the screen for 15 minutes. Which screen? This one. How do we set up this screen? I will explain. Why have we chosen the instruments we've chosen? I will explain. Why these time frames? I will explain. But for now, my friends, I want you to write all of this down. I want you to write down that I want you to be scanning 12 to 20 products. What do I mean by products? Well, a product is, for instance, euro dollar, the DAX, Ripple, Apple, and so on, and to Amazon, Ethereum. How did you pick those products? I'll come to that in 1 second. Okay. One screen. You don't need lots of screens. If you want lots of screens, that's fine. Go buy them on Amazon. They're about £100 per screen, but one screen is fine. I want you to do 1 trade per day minimum or 5 per week. Okay, cool. You can't do less than 1 a day, can you? Okay. Why not more? Well, you can do more if you want. I just want you to be really aware that the best traders in the world don't overtrade. The best traders in the world pick quality trades, quality over quantity. Now, you should know this from what your mum told you when you were little, quality over quantity. It is best business practice, best practice in everything. Okay, but I'll show you mathematically why. I think it's a process for private investors, not for hedge fund managers necessarily. You've got supercomputers doing hyper-fast trading, but for private investors, I'll show you why mathematically this will make us ample. We're not here to be greedy. We are here to make enough without failing. We're here to drive as fast as possible safely. All right. That's a very different mindset to what you might have heard elsewhere. All right. So we're going to get rich, not slowly, and we're not going to get rich quickly. We're going to get rich safely. All right. Because that's the only way to do it. It's the only way to do it. All right. And that would mean one trade a day means 20 trades per month typically. And I'll show you why mathematically that works out well. What I want you to do when it comes to currencies, and it's not just currencies we're going to look at, the ones I found that trend the best and that I want us to focus on, but you don't have to do it exclusively, is major versus minor currencies or minor versus minor currencies, which begs the question, what the hell is a major currency? A major currency is any of these four, dollar, sterling, yen, or euro, and a minor is all else. I've just found that they tend to, and I've got no scientific proof for this. I'll tell you when I don't have scientific proof, okay? I found that they tend to trend more easily. Doesn't mean you should do that and nothing else. I'm just saying that I found that a little bit easier. And I found these times the easiest times to trade. Okay, because that's when I found that the markets trend the best as well. Now, I could go into a whole explanation as to why. It's because it's when the most traders are the most attentive or the least attentive. When they're the most attentive, you tend to get bigger trends because they're all there throwing the money around. When they're the least attentive because they're buggered off home, you get people able to move the markets more. And when they're just in between, well, you get indirection, indecision. That's one theory. Doesn't matter what the theory is. I'm just talking about empirical evidence. We use the scientific method, okay, which is empirical evidence, observation to back up our theories. That's how we do it. That's the scientific method. I didn't come up with that. Winton Capital, $35 billion came up with that. And my favorite time frame is actually the 1 hour and the 30-minute time frame, and I'm going to show you why in a second. I particularly like that time frame. Now, okay. We're going to look at some of the live trades in a second. Before we do, there's certain things I want you to recognize on the screen anytime I show you the screen. Okay, here is where we choose all our products from. Now, I don't actually care what products you trade, like I told you, but I'll give you suggestions of what I like. Okay, I'm not hung up on, oh, only do this, don't do those. Ooh. Okay, I'm not hung up on those, but I'll tell you what I like. And then we're going to look at our screen and it's going to be broken down into A, B, C, and D. A is the green arrow where we get into a trade. Okay, so we need to ask ourselves, well, how do we get into a trend? Why didn't we bottom fish? Well, I'll explain why in a second. Okay, how do we know that the trend's in our favor? How do we evaluate it at any given time as well? How do we decide point B, which is our stop loss? It's the yellow line here. How do we decide that? Okay, and we need to know if we've decided that stop loss, how do we then decide how much money to put into a trade? And how do we decide where to double down on our position, which is point C? And what do we do about these shitty trades, point D, where look, you got a down arrow and that was a losing trade. So let me do that on this example on the screen now, and then we'll move to the live trades to show you what we're trading right now and how you can look at that and how you put this process all together. Then we're going to do a business plan. We're going to show you the strategy with exact numbers. So we've got quite a while to go. Okay, grab that pen and paper, get everything ready. Yeah. So I'm going to come to the strategy part in a second. How do we decide to get in there and not there? Let's discuss point B first. One of the things I discovered about the secrets of the wealthiest, the richest, the people who've gone from zero to being billionaires, and I'll show you some of their names, is that in trading, they all used a similar technique. And Bill Lipschutz first told me this. Like I told you, he's my mentor. He's the global head of foreign exchange at Salomon Brothers. He was in my book 20 years ago, Mind of a Trader. And he said they all used what's called volatility-based stop losses. So if there's a secret to rich, it's volatility-based stop losses. Not exactly a sexy-sounding secret to rich, is it? What's a volatility-based stop loss? It means we put our stop losses based on the noise and the volatility of the market. The more volatile a market is, the further away the stop loss. The ingenuity of that is every stop loss is bespoke to that trade. Well, Alpesh, that's a lot of mathematics. Actually, it's not. I'll show you how we can speed that up, but we can do that manually. Now, some people, like me, would tend to do it through experience. Okay. Others will say, oh, I'll put the stop loss below the most recent low. Others will say, no, I like a more mathematical approach, which is 2 times or 3 times the average true range, and so on and so forth. Okay. I don't care which methodology you use as long as you use that principle. Now, we have algorithms which actually finesse the numbers, and so we get a better, more efficient trade, but that's because we're at the efficiency, productivity improving end. But for private investors, it's the principle that matters. So what do I mean by noise and volatility? What I mean is this. Notice how the market in any period, whether it's the 1 hour period or the 1 day, moves up and down a certain amount, whatever that is. That's what we call volatility or market noise. We take the average of that and we might double or triple it to set our stop loss. They might say, well, what if, Alpesh, the market's twice as volatile and so the stop loss is twice as far? Well, we'd halve our position, so that we don't lose more money just because the market's more noisy. That protects us even if we're in the more volatile cryptocurrencies, because if it's more volatile, our stop loss is just further away and our position size is half. But surely, if your position size is half, you're making less money. No, because the stop loss was further away anyway. You're not making less money. You're taking a commensurate amount of risk. See, that's where people go wrong. They think about how much money they're going to make as opposed to how much they might lose. Rich people think about how much they might lose. Poor people think about how much they might make. Okay, counterintuitive though it may seem. Well, you're going to find in this webinar, everything about being wealthy and successful is counterintuitive. Otherwise, everybody would be wealthy and successful. Okay, so 2 secrets. 1, volatility-based stop loss. 2, volatility-based position sizing. Like I said, if the stop loss is twice as far, we halve the position. But how much should that loss be? Well, here's the secret. The loss should be such that whatever amount of money you lose if your stop loss is hit, and write this down, okay, then you don't lose any sleep. Now, some people go, oh, no, surely the loss is 1% of your capital. No, it's 1% of your capital if you're a hedge fund and you're trading 80% other people's money and 20% your own. All right. When you're just a private investor with your own capital, the amount you risk is such that you don't lose any sleep. Why? Because if you lose sleep over it, psychologically, you won't take the loss. If you don't take the loss, you'll double down on that loss because you're so hell-bent on being right. And then when you get a little profit in something else, you'll take that profit too early. You'll cut your profits too short on your winning positions. You'll focus on your losing ones. You'll be distracted. You'll double down on the losing positions, which go lower and lower. You'll blow up and you'll go, oh, that's terrible. Okay. George, I can arrange that for you. I will do that just for you, my friend. Will you email me and I'll make sure I do that at the end, George. Not a problem. Since you're keen, I want passion. If I get passion, I'll bend over backwards for it. Okay, so there you go. All right. Now, that's the principle of that. But what about the other half? And oh, by the way, what's ingenious about having that principle is we can start small. Well, you might think, well, wait a minute, starting small, surely I want to start big, because you're going to tell me a secret holy grail to being right all the time. And if you're right all the time, then you should bet big. Yeah, guess what? If you can find a crystal ball where you're right 93% of the time, and George Soros hasn't found it yet, and Bill Lipschitz hasn't, none of the biggest money managers in the world have, and you might think, oh, well, they're all shit, but Alpesh, you surely have got it. No, I haven't got a crystal ball either. But if I did have, and I could see the future, and I could always be right 90% of the time, oh, my friends, I would have mortgaged my house and my mother-in-law in order to have put all my eggs in one basket and just done one trade. Self-evidently, that isn't the case. Otherwise, I wouldn't have to do more than one trade, would I? If I can be right 90% of the time, I only need to do one trade and put all the money and borrow it from every credit card and every friend that I've ever met. Okay, and just put all the money into that. That's how you know people are bullshitting you when they say they're right 90% of the time. All right. Instead, what we're trying to do, knowing we're not going to be right 90% of the time, knowing that a coin is right 50-50 and we're just trying to be right a little bit better than a coin, what we're going to do is start small, because we know we don't know that we can be right every time. And then when we are right, we double down. Where do we double down? At point C. What's point C? Point C is a mirror reflection of point B around the entry of point A. Point C is a mirror reflection of point B. Okay, it's just a mirror reflection. That's all it is. And that's where we double down. Why do we double down? Because then we're risking profits and not our capital. That adding to our winners. Winners add to winners is what some of the biggest hedge funds in the world do. I didn't invent it. I didn't think of it. Paul Tudor Jones, who's a billionaire, came up with it. You can look him up. All right. He came up with it. And then Bill Lipschutz did it, and Winton Capital do it, and all the best companies do it, because in game theory terms, it's an optimal strategy for success. So that even if I'm only right as often as a coin and 50-50, then 50% of my trades, I get to double down on the profits and make profits, and 50%, hey, guess what? They get cut out at a small loss because I started with a small position. Right? Now, those are important principles you need to learn. We'll come to some specific figures in a second. Why do I bang on about foreign exchange? I'll put cryptos to one side for a second. Why do I talk about foreign exchange? It's a $5 trillion a day market in euros, yen, sterling. That's why. It's liquid. Therefore, you can trade it 24 hours a day, 6 days a week. The spreads are tight, and brokers charge no commissions very often because it's a highly competitive market. So there's a lot of choice of brokers, and we'll talk about brokers and how they rip you off later and how to avoid getting ripped off by them. Okay, because there's no point learning everything I'm going to teach you and then have the broker steal all your bloody money, is there? All right. The reason we don't like stocks is because you have to pay lots of commissions, and that's because they trade hardly any money and they're not as good. Okay, a bit of data for you, and this is taken from a major American broker called FXCM. I'm not endorsing them at all. All I'm saying is this is what they found in terms of percentage losing and winning according to currency pairs. Australian dollar, New Zealand dollar does really well for them. I'll come to which trades I've got open at the moment, but I just thought I'd share this with you. You might want to take a photo of it on your computer screen, okay, with your phone. All right. Everything in trading gets broken down into these principles. And our strategy, I'm going to show you the strategy we're going to use, so the live trades and then a business plan for profit in a second, is stop loss. Where is that? Entry, limit orders, movement, money, and additional positions. Well, I've discussed some of this already. Movement, that's wrong, actually. It should be mind, not movement, trading psychology. All right. And that's the acronym. All right. So just remember the acronym. We're going to put everything into it. Put again, the stop loss was based on the principle of market noise and volatility. And that then answered everything else except our entry. How do we know when to enter? How do we know when to enter? So that's the bit I want to get across to you. That's the strategy bit I'm going to come to in a second. One thing for sure is trading is not like this. It's like this if you're a bloody hedge fund, okay? If for no other reason than when your investors come and meet you, if you don't have so many screens, then they think, what's he doing? Yeah, does he really know what he's doing? To be honest, most of the time, and I'll let you into a little secret. Let me let you into several secrets. I don't care. Okay. We pay rent in Mayfair of £15,000 for a small office, which seats about 4 people. That's how much it is. Why Mayfair? Why pay rent? Well, I can't afford buildings in Mayfair. That's for a start. And most funds end up renting. £15,000 rent a month. Why Mayfair? Well, because if you're not there, you can't raise the capital to put into your fund. 80% of it, well, actually, no, 90% of it is other people's money, 10% is mine. Okay? That's how it works, right? Just so you know how it works. You don't care about any of that, but what you do care about is every time you see somebody trying to impress you with so many screens, don't be impressed. You don't need that as a private investor. That's what you need if you're running capital. All right? Everything I'm going to tell you is about managing risk. I've been writing about this in the FT even. Do your sums right. So everything is about sums. If you do your sums right, this is what your trading is going to look like. This is what the trading of the best traders in the world looks like. You will have no big losses because you've got that volatility-based stop loss. Because you can't predict the market, you will have some small losses, but they will be small because you've got small positions hitting your stop loss. You'll have some small wins. Why? Because you cannot forecast the markets and trends turn. Okay, but you will have big wins, but they will only happen this many times. Alpesh, why aren't you only got wins? Because I can't force the market only to trend. Got it? Can't force the market only to trend. And whenever it does trend and we get those, then we double down in them. So that's why it looks like this. This isn't just my performance. This is the performance of every single successful trader in the world. Of the 100 trades they do, 20% will be the big wins, which make the real money. Okay, but the secret to success is making sure you never have big losses. You know why private investors have big loss, aren't profitable? Because they have big losses. Put your hands up if that's you. I bet yours looks exactly like this, except you've got big losses. I bet you. I guarantee you. I'd bet my life on it. I know enough private investors over the last 20 odd years. And by the way, being one and having gone through the frustrations, I know it. I knew the secret was getting rid of that. That's all it comes down to. But there's some other secrets. We're going to talk strategy now. One of the other key factors is strategy that works. Well, what the hell does that mean? A strategy that works is not one which by some miracle, you ain't got these people say, oh, look how we got the top right there. They're lying to you. Okay, strategy that works is one which already lets somebody else take the risk and follows on the back of their coattails to that trend. Okay, so we're going to look at that. It also means it's got to be simple and clear. It's got to be something that has a logic to it, not something you can't understand. Oh, it's an Elliott wave, third wave, or Fibonacci. It's based on the internal mathematics of a 17th century Italian Renaissance man, mathematician, who noticed that the patterns inside rose petals replicate themselves in the stock market. Yeah, if it doesn't make sense to you, then don't bloody trade off it, because you won't be able to explain it to your wife or husband when they say, how did you lose a fortune? Oh, it's Fibonacci. Yeah, so it's his fault. All right. A simple, clear strategy which has inherent logic behind it. So I'll have to explain when I show you the strategy why humans are doing what they're doing and why we're getting off the back of it when we do that. Okay. And why we think there's an increased probability, and everything is about probability and odds in our favor. Mark, I'm on London time. Yes, indeed. It's 1956. Okay. Stop loss strategy that prevents big losses. Well, I've already discussed that. Okay. And the reason is this. If you want to be right 100% of the time, but still be a loser, this is what you do. You keep your losing trades open, which is what most people do, and they exit their winning trades. And there are more people who send me emails every single week saying, oh, Alpesh, I'm right 9 times out of 10. I'm right 9 times out of 10. And then do you know what happens? They don't tell me about the 10% time where their losses are getting bigger and bigger and bigger everywhere. Okay, so we're going to avoid that through what I've told you. One of the reasons why the market's rallying like crazy at the moment is every time we get a pullback, it's coming back up. Everybody's buying into these pullbacks because we're getting the trends rise up. So I don't care whether you do a pullback strategy or a trend following. We're going to look at trend following. Okay, I just want you to know that. This was from Thomson Reuters, but I wanted to show you some of the technical data reasons. Everything I do is based on data. This is where Goldman Sachs says we're at this phase. So this is why I want to look at the short end of the market and why I'm looking more at trading and not just buy and holding the stocks I told you at the start, because I am truly fearful in terms of what Morgan Stanley have said, and it's what they're telling all their rich clients, that we have got tougher times coming ahead. That's what's causing me afraid. What else is causing me afraid is this research from Goldman Sachs, that we have got valuations looking very stretched. So whilst the stocks that I told you were great for valuation, great for growth, great for income, and great, I believe, to hit the targets I've set on a buy and hold, I do not want to be handcuffed to a buy and hold position. I want to be able to trade the downside of the market in case it falls, because I need to be able to make money, not just if the market keeps rising and have to rely on and plead and hope and pray it rises. I need to be able to make money even if it falls. And the reason I'm also worried is this, which came from Bloomberg, is we have got one of the largest market runs ever. Now, don't dwell on all this. This goes all the way back to 1932, okay? But we have got one of the largest rallies ever. So that's what makes me worried. And here's some more research from Barclays. I promised you in this email that I'd give it to you. Since 1881, yes, I look at this quality of research this far. We have got... okay, it's only been more expensive than this twice ever. So I need to be able to short and trade trends, because when the market falls, and it's likely to do, because again, Bloomberg said that it's having very few days. It's 444 days without a 5% drop. That is almost unheard of ever. So what the rich banks are telling their clients, and I want to share this with you. I'm sort of the Robin Hood of taking from rich clients and sharing the information with everybody else. This is what Goldman Sachs are telling their richest clients, and this is when the things I get worried. What they want to know is how do bear markets start? That's what they're advising their clients. Okay, I've stolen this from some of the research that comes across my desk from Goldman Sachs. They're telling their wealthiest clients, let's analyze for you how bear market starts. Well, obviously they are, because they want to make sure those rich buggers stay rich. And so what they're saying is, what they often find is you get a last hurrah, and this is the pattern. I want you to memorize this pattern. This is why so many private investors lose money. And you might think, well, that looks innocuous. What happens is the market accelerates and then drops off. And so you think, oh my God, that's it. It's the end of the world. It's dropped off. And then it rallies again. You think, oh, no, it's not. I was wrong. Look, it's going back up. What a fool I've been. And then it drops and they never get out of it. So that's what we're going to watch. Don't worry, I'm going to give ample webinars to make sure that if any of this happens, you'll have ample notice. You're all on my mailing list. You'll have ample bloody notice, okay? I will steal that information from Goldman Sachs, like Robinhood, and make sure you guys have got it. They won't give it to you direct, but I'll make sure you've got it. And one other reason why I'm worried is this. A third of the S&P 500's rally is down to just these companies: Facebook, Apple, Amazon, Microsoft, and Google. A third of it is down to just those companies. Right? That worries me. Let me give you one more reason why I'm worried. But don't worry. Worried means I'm excited for the opportunity to short things. And how we're going to do it is the trading strategy I'm going to show you with the trend following. This is based on price earnings ratio, trailing price earnings, price to book, dividend yield, and CAPE. Okay, these are all measurement ratios. Schroeder said each one of these countries and regions in red is overvalued. Look at the amount of red on that screen. Okay, RPI, everybody who's on this webinar is on the mailing list. Don't worry, you're on it. You're on it. You're on it automatically. Okay, look at the amount of red on there. So I need to get ready to short. Whilst I'm bullish right now, I need to get ready to shorten those trends. But yet there's another reason. Okay, and this stuff has come from Societe Generale, Soc Gen, because I don't just look at Goldman's, I don't just look at Barclays, I look at every single multiple source. What they're saying is for the S&P 500 and the FTSE 100 and the CAC 40 and the DAX and all of these other indices is by the end of 2019, compared to right now, which is here, they are seeing significant drops. Now, guess what happens? It becomes self-fulfilling, okay? It becomes self-fulfilling. Why does it become self-fulfilling? Because every time they tell their rich clients this information, their rich clients say 20% drop, 19% drop. Oh, shit. That's why I want you guys to be aware of this and be prepared for this. Congratulations to all of you for being on this webinar, being diligent and being bothered enough to learn something about it, okay? Moving forward, new and previous 12-month forward bull, base, and bear price targets from Morgan Stanley. This is what they're saying for the major indices like the S&P 500. The bear case is drop of 20% plus 40% in the case of emerging markets. EM is emerging markets. I want you to know this because now you'll understand why I'm also going to teach you a strategy to profit from market falls, because my friends, it's coming. You felt it in your water anyway. And the other reason I think it's coming is this is from Morgan Stanley as well, going back all the way to 1980. Whilst it shows every year the rallies, it also shows in the red dots the intra-year falls and how big those falls can be. And guess what? They can be as big as 49% or 34%. Remember 2008? Okay. So I need us to be ready for the downside as well as the upside. I've given you ample data to prove that. I mean, don't get me wrong. Bank of America Merrill Lynch says that the equity bull market still has gas in its tank, and that's what it's foreseeing. It also, according to JP Morgan Asset Management, says on the multiples, the valuation multiples we've got at the moment of 17 times forward earnings, yawn, Alpesh, I know, it's not as rich as it's been when we had the bubble in 2000, but it is higher than when we had the credit crunch in 2008. So you might say, oh, well, okay, on the one hand, but on the other hand, that's why I've got to be ready both sides. And the reason I'm looking at Forex is it gives me that liquidity. Okay, it gives me that liquidity. Let's just look at some of those trades right now that we've got going, and then I'll show you the strategy. This is euro dollar. All right, we are long euro dollar at the moment. All right, and then I'm going to show you the strategy. I'm going to show you the business plan in the webinar and show you how to become my apprentice if you wish, if you've liked what you've heard. All right. And no, it's not a trading course. It literally is apprentice. You can email me. I'll show you my trades. You look at mine. I look at yours and make sure that you're good in your own time, wherever you are in the world. All right. We were short. We're long. All right. At the moment on euro dollar. That's on the 1 hour. Now I said, yeah, there's the 1 hour. There's also the 30-minute. Now we're not going to trade 1 hour and 30 minutes simultaneously. There's a 30-minute bar on the same stock. Okay. We're going to pick a time frame. We're going to stick to it. I think we can even look back at 15-minute. There's no point doing 15-minute, 30-minute, and 1 hour on euro dollar. But if you want to look at it, whoops, this is the euro dollar 15-minute bar. There it is, massive, healthy rally in it. The price, if anyone want to check, it's one spot 2070 to one spot 2071. So it's 70 bid to 71 offered, okay, on euro dollar. You can Google that, okay, if you want to have a look at that one. But that's what we're trading at the moment. That's the short-term trading. That's the live trade. These are the things I like at the moment. For those of you who want to know, well, what are you trading? What do you like at the moment? These are the ones we like at the moment. Let's go through some more of them. I ask people every day, 15 minutes before and after work, to scan these 15, and I'll show you why you pick only one trade a day. So over a course of a week, you might have 5 open trades and how much money you put into them in a second, okay? And what we're doing, having done that, and this is the DAX trade, by the way, okay, this is the DAX, which has been long for a while. If you saw my webinar last week, you'll know been long DAX for a heck of a long time. We double down here, we double down here. Notice how I didn't get in at the bottom. What do I care? Is that not big enough a rally? Yes. We're not trying to be greedy. We're trying to be sensible, safe, and secure. Okay, sensible, safe, and secure. Okay, let me just move it back a bit so you can see. I had to go from being short on the DAX to being long. Well, only thanks to computers can I have the freedom of psychology to be able to do that. Let's go back a bit so people don't think I'm just cherry picking on these things over here. We had the short trade here, which got us out where that X arrow is. How do we get that? Well, that's when our indicators tell us that the momentum and the trend is down, and this tells us that that initial indication situation no longer applies. Let's look at this one. Look, we got in a bit late in that, but that's fine. Had a small rise. That's the whole point of it. Not every trade like this is always winning. 1, 2, what have we got? 3, 4. You don't expect to be right every single time, but what you do expect is when you're right, you make more than when you lose, because when you lose, if that had gone down, you get a short, sharp loss, small in size, short in duration. When you win, you get longer wins. That characteristic is the characteristic of profitability, okay, as well. David, I'll come back to you on your problems with Java shortly. It's a computer problem, not a problem at our end. Try using different browsers, try and update your whole computer system as well. Free upgrades are usually available through Windows. All right. Now, let me tell you what we're doing. I banging on about Ripple, didn't I? And I said I've got a long-term buy position in it. I've got more of my personal wealth as of today in Ripple than in any other investment in stocks or Forex, would you believe? Now you might think, what? Yeah, that's how excited I am. Hey, that's my problem, not yours. That's my problem. All right. This is Ripple. Okay, so why forget the long position there? What I want you to show you is, let me just zoom out a second. Okay, what I want to show you is that short there. Okay, whoops. Let's show you that short here. All right, this short here. Whenever we can, given that I've already got a long position in it, whenever I can, what I want to do is try and short it. Why? Because I've got a massive long position, so which is for the long term. It's for 3 to 10 years. It's for my kid. It's for my nephews, nieces. All right. So when I can, and why am I looking at 1 minute? Well, bloody hell! Have you seen how much this stuff moves? But anyway, that's a foible of mine. You don't have to worry about that one so much. Similar kind of strategy with Apple. Okay, long-term, long view on Apple, as you know. So whenever I get a short sell, I love taking that. There's no point in me being long-term long on Apple and short-term long as well. Okay, so just so you know about that. Let's go to cable. And this is where we are at the moment on this one. Now, this is a good one because you can see a mixture of good and bad trades. Yes. Okay, this one, there we go. This one was a really lovely long. This was a short, okay, which is only a tiny bit of a profit there, but this one was better. This one was good. All right, this one's losing at the moment. So I don't want you to think, oh, only chooses a winning position. No, because our current short position on it's losing. But that was good. This was a very good. This was a very good. This was not nothing. And this was very good. Okay, my point is this is a nice trending pair. Now I said, okay, that I don't like major versus major, like sterling versus dollar on the whole, but at the moment it's been trending nicely, so love it. And that's the 30-minute. 30-minute or 1 hour bars, those are the ones I want my friends, I want you all to focus on, okay? I think we can look at the 1 hour as well. Let's look at the 1 hour. We're not trading the 1 hour on this at the moment because we're trading the 30-minute and they're too similar. Okay, you can see on the 1 hour how you got that. All right, and you got that, but you also got some small losses. That's fine. Any good strategy losses should be small in size, short in duration. Some of you may be able to spot other patterns like head and shoulders or whatever else. That's fine. My point is no one thing, including head and shoulders, works all the time. So how do we determine when these trends are coming back? How do we know that Goldman Sachs has just shorted a load of sterling and therefore caused this to happen? How can we x-ray vision that so we can ride the coattails of it, so we can get back, so we can get in on it? And by the way, on the FTSE, that puppy's been brilliant, and you'll have seen from my webinar last week and beyond that's just been a don't touch it. And what can I do? Bloody hell. And it's just been going in one direction. So there's not really much you can do. You can't do much other than double down on it there and double down on it there when it's just going in one direction. The Dow's not been as good on that. Well, look, we'll come back to some more of these trades in a moment. What we need to know right now is what's the strategy. Okay. The strategy. Oh, first of all, before I tell you the strategy in the business plan, let me get you a bit psyched up. Guys, you, all right, can be better than an overpaid, fat, balding fund manager. And I'm not referring to myself. I'm referring to somebody who manages £9.2 billion. Why can you be better than somebody like Neil Woodford, who says, I'm sorry for poor performance? Well, the reason is I am, all right? I am. This is me in 2004, beating him in a competition in the Financial Times over a 12-month period where the FT said Patel is top FTSE 100 forecaster. I was a private investor. The next year I set up my hedge fund. Well, you would as well if you won competition in the FT and people are throwing money at you. Okay. I was a private investor like you guys, exactly like you guys. My point is I can do it. You can do it. All right. And my job is to teach you, because people like this are getting away with murder, $9.2 billion and having to say rubbish. All right. So I want you guys to believe. If you do not believe you can be successful, please leave the webinar now. Because like anything in life, if you don't believe you can be successful, then there's no point even trying. All right. No point even trying. I'm also very good at training apprentices. I'll tell you how I know this. All right. Newton Investment Management. Naomi Wastel, investment manager, manages $10 billion now. She left University College London, joined me as my assistant, worked for me for 5 years, and then joined Newton Investment Management, now manages $10 billion. Okay. I trained her up for 5 years. She got the job at Newton, manages $10 billion. I'm pretty bloody good at what I do. Okay. I don't need to take you through these. What I do need to take you through is this bit. Trend following. So what's the strategy we're going to use? I'm going to show you the strategy, then I'm going to show you the business plan, then I'm going to show you how to become my apprentice, how to use the software to pick these trends as well. Okay. From inside Newton Investment Management, from Winton Capital, $35 billion. They're based in Hammersmith. I want to use them so you don't think, oh, well, Alpesh, why should we trust you? Well, you should be able to trust somebody running so much money like these guys. Okay, what we're looking to do, this is their slide, not mine, but I use the same principles because me and a bunch of other people, we're all trend followers. What we do is we get in after a lag. Oh, I know what you're thinking. Alpesh, but all these indicators are lagging. That's bad. Guess what? It allows you to take less risk. The trend starts here. You're not a bottom picker because that you might be getting in too early. And the probabilities are too low. The probabilities are too low of getting in there. For those of you who remember your calculus, d2y over dx squared. It's a local regional maxima. Okay, we're looking at that curve to be at zero, point of maximum acceleration for those who remember their calculus. Forget all of that. What we're looking to do is buy after a little period of lag because there's a higher probability of being right. We're trying to get the meat of the move. We're not trying to suck the marrow, every last bit. We're just trying to get the meat of it. And then we sell because we don't have a crystal ball telling us when the bottom and the top is. How do we do this? The way we do it is what's called, you might have heard of it, momentum-based trading, where somebody else moves the market like a Winton or a Goldman Sachs or a SocGen, and we ride their coattails. Okay, they move the markets. They might have a self-fulfilling prophecy. It might be anything else. We are just riding their coattails. How do we know trend following strategies work? Well, because they led performance in 2016. I'll get the data soon, who led performance in 2017. We know they work because for about 30 years, people like this have become billionaires doing it. You can Google their names if you like. If you're going to do it, Google David Harding. He's my hero. He's the founder of Winton Capital. Okay. Google people like Bill Lipschutz, Global High Foreign Exchange, my mentor, who was in my first book, Mind of a Trader, and John Najarian, who was also in that book, and also Bernard Opity, who was in that, and David Kite, all trend followers, okay, who've, in the case of Ed Seykota, $5,000 into $15 million. All right, and these are the assets, according to the Financial Times, since 2005, going into trend following strategies, billions of dollars, $250 billion to be precise. So, two things to do in this webinar. First, give you the business plan. Okay, can we even make enough money to make any of this worthwhile? And then how do we find those trends? Okay, so let's do the business plan first, and then how do we find those trends? How do we make sure that when we're looking at multiple indicators, which no one indicator ever works all the time, no one methodology works, so how can we filter to make sure that we are doubling down on our probabilities of being right? But before we do the strategy and trend following and the apprenticeship bit and all the rest of it, let's do the business plan first. My job is to teach you to drive as fast as possible safely. So Bill Lipschitz said to me, we need to look at a business plan. If we're going to make money, Alpesh, getting wealthy, because that's what I wanted to do. Remember, I met him when I was at university. I didn't have a silver spoon in my mouth. So I said to him, look, should I do this for the rest of my life or should I be a lawyer? Because that's what I was trained to be. What should I do, Bill? And he said, well, let's do a business plan for you first. And he said, first thing you do in a business plan is you work out what's the maximum loss. And let's say, because it's a business plan where you intend to get to, it's 1% of your total capital. Okay, is the most you're going to risk is 1% of your total capital. Okay, and I said, fine. And because it's a business plan of where we intend to get to, it's not how much money we've got today, it's how much we intend to have. So let's say the total capital we intend eventually to have through friends and family and whatever is £20,000 to trade with. Just take that as an assumption for now. I'm going to make a lot of assumptions, take them on gospel truth for the moment, and then I'll show you how we mitigate some of those assumptions later, because we're trying to work out, is this trading monarchy even worth doing? In this part of the webinar, we're trying to work out how much money we're going to make, how quickly we can make it, whether it's worth our while doing it. Okay. Therefore, 1% of £20,000 is £200. So the maximum loss per trade would be £200 on this theory. Don't worry, we're going to come to the strategy in a section of knowing when to enter, but this is a theory. Let's assume we're really good and we're really proficient and we're really good and we win 100 trades. Sorry, we win 70 trades out of 100 and we lose 30 out of 100. So the win-loss ratio is 70-30. Okay, 70-30. Win-loss ratio is 70-30. We win 70 trades out of 100. Now, I'm going to show you later why that's irrelevant. It's not about how often you win. It's about how much money you make. But for the moment, just bear with me. So the average loss is £200, 1% of 20,000. The average win is £300 because we're adding to our winners, and we're going to pick a strategy where we make more when we win than we lose when we lose. So just assume, for the moment, take this assumption, we're going to win £300 because winners add to winners, remember. All right. When we win, then we lose when we lose. All right. So let's say we do 100 trades. If we do 100 trades, then 70 times 300 would be profits of £21,000. That was more money than I'd ever seen as a student. So I said to Bill, call my parents, tell them I want to leave university. And he said, well, hang on, you've got 30 trades, which are losing £200. That's losses of £6,000. Net profit of £15,000 per 100 trades. Well, that's more money than I'd ever seen. So I said, oh my God, all I need to do is do 100 trades, sit in front of my laptop, tap the keyboard, and magically money will come into my bank account. All I got to do is do 100 trades on my strategy, whatever that strategy is that Bill will kindly give me, I'm sure. And I'll make £15,000 per 100 trades, and I can be a day trader, because that was all the glory name back in the day. Okay, so that's the notion I got into. And I said, look, if I find a strategy which allows me to do 100 signals in a day or a week, I'll be called a day trader. Even if I do them in a month, I keep my day job and be called a day jobber, it's fine. Look at the maths, Bill. And this is when I got overexcited. I said, look, day trader, I can do 100 trades in a week, 50 weeks in a year, because the other 2 weeks I'll be driving around in my Ferrari, won't I, or my Lamborghini or something stupid. Okay, 5,000 trades per annum, therefore, at £15,000 profit per 100 trades. Oh my God, I'll make £750 per annum. Yeah, I know what you're all thinking, and you should. Alpesh, we're not going to do 90% of that. We're not going to do 3/4. We're not going to do a half, a third, or a quarter, or a fifth, or even 15% of that. Let's say my business plan is over exuberant, as Bill said it was. Let's say we only do 10% of that. Well, 10% of that is £75,000. 10% of this business plan is still over optimistic, because I said our goal is £1,000, 1K, per month. Okay, small goals get achieved. Baby steps are achievable, not ridiculous sums. 1K per month. So even if 10% of this business plan is right, we are still well within our goals. Well, hang on, that's too over optimistic. So I said, okay, Bill, what if I keep my day job so my parents are happy and I only do 100 trades every 6 months or 200 trades per annum? At £15,000 per annum, that's £30,000 per annum, which is less than half of the 10%. It's closer to 4% of our business plan. But that's still almost 3 times more than the 1,000 a month. So we took 10%, we halved it, and that was still 3 times more than our plan. But you know what's good about 100 trades per 6 months? First of all, it allows you to keep your day job, so it's more manageable, more realistic, but it's 1 trade a day. It's exactly 1 trade a day, or 5 per week. You can collect them all into 5 per week. So it was realistic for regular people, for normal people. Normal people aren't going to become day traders. They're going to do 1 trade a day or 5 per week, especially when they're looking at this many screens. They can pick out of this 1 a day, 1 good quality trade a day. I know you're thinking, why can't I do 100 in a day? Don't. You'll do low quality. But you should be asking yourself now, well, wait a minute, Alpesh, if all this is correct, if these maths are correct and we take 10%, then we halve it and then we reduce it, how come everybody isn't rich? Because that's what I asked Bill. Well, first of all, there's 3 good reasons, he said. And that's what you should be asking me. How come everybody isn't rich then, if this is true? 3 key reasons for failure: bad teachers, bad mentors, bad strategies. Let's deal with strategies, the final part of the webinar. Then we'll discuss how you can be an apprentice. If you want to be, follow me, use my software. Send me your trades. I'll send you mine so you can be an apprentice, okay, as well. All right? Bad strategies. Let's look at strategies. So the strategy Bill gave me, which is one of the 10 strategies we use in my fund, you might think, well, why are you disclosing it? Strategies are not a scarce resource. If you want strategies, go to Oxford University. They'll give you strategies. Raising capital from pension funds and sovereign wealth funds, willing to give you tens of millions. That's the scarce resource and the secret source. Strategies aren't. So Bill said to me, we're going to need a strategy. It's the final part of the webinar, then the apprenticeship bit, and the Q&A, okay, and the software bit, okay? He said, what you should do to find that momentum, to follow those trends, to ride on the coattails of others is this. Measure how close to the high the price closes in any period. I said, how? And why would that give me an edge? How does that help me get on somebody else's coattails? He said, well, when the price closes near the high in any given period in any product, psychologically, what humans are doing, or computers programmed by humans are doing, is they're saying, oh, I'm bid 40. Now I've got 60. Anybody give me 70? I've got 70. Anybody give me 88? I've got 80. Anybody give me 90? It's like an auction. The psychology of it is momentum. Might even be a bubble, but it doesn't matter. What it's telling you every time is there is an increased probability, not a certainty, but an increased probability that in the next period, the price is likely to move higher. I said, yeah, Bill, it's all very well saying that, but how do I do that except with a magnifying glass? And I don't do it without paying for any software because I'm a poor student. I certainly don't want to pay software. I don't want to pay any subscriptions for data and for prices. So he said, no. There's ample free stuff out there on the internet. What you've got to do is amend it suitable for a private investor. I mean, he wasn't going to tell me stuff that Solomon Brothers does because I couldn't copy that. I'm a private investor. He had to tell me stuff that a private investor could do. He said, well, what we'll do is use the same 3 things that every fund in the world does for its strategies. First of all, because no one strategy works, no one indicator, no one measurement works of measuring how close the price is closing near the high, we will use multiple measurements or multiple indicators. So we'll triple filter, we will use or quadruple filter, whatever. It's like filtering water. Because no one thing works all the time, we'll filter to see multiple indicators. And only when all of the indicators are suggesting that there is momentum we'll be getting, well, what are these indicators? I'll tell you. And he said, we'll use them in the way the textbooks don't. Okay, so write this down. Multiple indicators in a way the textbooks don't, because if the textbooks were right, textbook writers would be rich. Okay, so I said, well, what does that mean? I'll show you that in a second. He said, what we'll also do is, because we're trying to find trends, we want not just short-term money, but we want longer-term money pushing in the same direction. So we will look at multiple timeframes to increase, and write this down, our probability of being right and the size of the trend. We will look at multiple timeframes, like I showed you earlier. When we did this, we didn't just take what we're looking at sterling. We didn't just necessarily look at the 1 hour time frame. We might look at the 30-minute or the 15-minute or whatever else it might be to see, are we getting the trends in multiple timeframes? Okay, to make sure, are we capturing those beautiful trends every time? So, okay, so we'll look at multiple timeframes. So if we're looking at multiple indicators, multiple timeframes, what's the third sort of secret all hedge funds use? Okay, well, the third secret was PC, which I'll tell you in a second, okay? So you can do it all manually if you wish. What we're going to look at is multiple indicators like the moving average, convergence, divergence, you might have heard of, but we're going to use them in the way textbooks don't. What we're going to do is look to see, are they flat to rising in multiple timeframes? So write that down. Multiple indicators, flat to rising in multiple timeframes, because that's telling us the price is closing near the high. But there was the third secret, remember, it wasn't just multiple indicators and multiple timeframes, okay? Multiple indicators and multiple timeframes. Remember I told you there's a third secret, PC. The third secret, which was the breakthrough for me, which led me to really make a breakthrough and start making real profits, get me from 90% to the 10% who were making money, was PC, price confirmation. What's price confirmation? It's when the price made a 2-period high. Now, why 2-period high? Well, our algorithms, our artificial neural networks told us a 2-period high was the optimal time frame, because that's when humans or computers programmed by humans are really pushing the price higher. And it meant that Goldman Sachs had put their money and they'd committed. They might not be looking at the same things we were looking at. We're just looking at whatever the price trails, the footprints in the sand they've left to say, yes, they're getting in. So that's when the odds had swung from getting in too early to getting in too late. That's when the odds had swung, that we've got multiple indicators, filtered out the dirty water, the dirty low probability trends, filtered it all out, multiple indicators across multiple time frames, so the longer term money was coming in. And even then, we're only trying to be right 6 times out of 10. Okay, because we're going to add to our winners. We still have our stop losses, remember. This is what put the odds in our favor, allowed us to be a trend follower. Multiple indicators, multiple time frames. So we knew the momentum isn't negative, and that's what we did. Every time you see this green arrow, which we then programmed into our software, every time you see that green arrow to go long, okay, that is telling us, that is telling me, all right, that is telling me multiple indicators, multiple timeframes, and price confirmation. So we don't have to do it manually. You can do it manually if you wish. And what these are doing is just giving me a traffic light indication of what it looks like. It's like a weather vane. Okay. And then we got the computer to also program in, so we didn't have to do it manually. You can do it manually if you wish. Where the stop loss is, it actually tells us the numbers in there for us and how much risk we're taking. So it's a lot easier. Because don't forget, in my firm, when I hire people and they're like 20 or 21, they've never traded before. I've got to teach them all of this. And the best way we did it was we created the software internally to do it. Okay, but you've got the manual rules, multiple indicators, and you can see them there, multiple time frames. So stochastic 2 means the next time frame along, MACD 2 means the next time frame along, and it's the principle of multiple indicators, multiple time frames. The real secret to getting rich, using computers and robots to scan the markets for you. Otherwise, you've got to do it manually, but that's fine. Okay, that's what led me to getting the column in the Financial Times, getting Merrill Lynch HSBC to pay me about $1 million for my research, which allowed me to fund the hedge fund in 2004. That's me, full head of hair, and pay for the administrators, custodians, the accountants, and all the rest of it. Now, I promised all of you that I'm going to tell you all of this, which, if you remember, I told you at the start of the webinar, I'm going to tell you all this, which I have done. I told you I'm going to tell you all of this, which I have done. And I said to you, if you allow me to tell you all of that, can I, in the last 10 minutes, tell you the technology we created? Can I tell you the technology we created? So we created this technology. We took the multiple indicators, multiple time frames. We're using it internally, okay? And what we realized, we called it Project pipspredator, is that I told my team, I wanted to create this because I think this is $1 billion technology. It's the Google of trading. We can float this technology like Twitter, like Google, and become $1 billion tech company. Okay. Buy when the price goes above the horizontal line, because that confirms there's price momentum and the odds of a profitable move have increased because multiple indicators across multiple time frames are showing us that the price is likely to rise, and the green arrow alerts us. I mean, it can send you an SMS, it can send you on the phone an alert. And I thought, you know what? That has got a global market of every single person in the world who's got risk capital to trade. Every single person in the world with risk capital of more than $1,000 to trade. Because you can open an account with $1,000. When we get new staff in my company, guess what we do? We start them off with $1,000. Why only $1,000? Well, for a start, it's my bloody money that they're trading with. And I don't want to risk it with any more than that. That's why we start, that's why we start them off with just $1,000 when they're trading. Okay, so what we worked out, what we realized with all of this is, hang on, if people can use this technology, then surely that's a technology which shouldn't just be kept within the fund. It's something which people can use. They can get trained up on. The secret to getting rich in trading is put the odds in your favor. So we gave this indicator, the Pips Predator indicator, to a bunch of apprentices. And what we worked out before the indicator and after, we did it before and after. There's no point giving somebody a tool which they can't use and it's too difficult. What we found is after the indicator, their confidence in the strategy increased. They had lower stress over losses. I'll show you how to download it in a second. They had a business plan for long-term profits. They had clarity of exits, clarity of entries, and clarity of stop losses. We worked out that, look, if the markets are going to collapse at any given time, we want to be in a position to go long and to go short. We want to be in a position, given what I've told you, that there's a high probability the markets are going to collapse, to be able to go long when we want. We want to be able to rely on ourselves, not just rely on Alpesh telling us, yes, go long today, go wrong. We don't want to be reading the FT every single day. We want to be able to pick a trade, be in control of our own destiny, and like any good apprentice should be able to, be in charge and ride those trends ourselves. Okay, some gains we might only be small. We won't get in at the bottom, but we'll do fine. Thank you very much. Okay, and some will be losses, but they'll be made up for massive big trends. That's what trading actually looks like when you're in charge of it, because this is what's relevant. Finding those trends, getting the computer to do it so you don't have the stress, you have the confidence in entries and exits. But then you've got to work out, well, okay, that's fine, but what's the most lucrative money-making time frame? I see how this makes life easier, like the vacuum cleaner makes life easier. Guess what the most important time frame is? It's the 1 hour time frame. Why? Because the 1 hour time frame will give you one signal in one product about once every 2 to 4 days. That means if you're looking at this many screens a day on the 1 hour time frame or the 30-minute time frame, even with a day job for 15 minutes a day before and after work, you will be able to find one trade where the signal is near the entry. And I only want you to do one quality trade a day, because if you then do one quality trade a day, guess what magic thing will happen? The magic thing that will happen is this. You'll be doing one trade a day, 25 in a month, mathematically. Okay. The net pips we were capturing is 2,250 per month. Now, some months it might be as high as 4,000. When, for instance, Donald Trump became president, there's more volatility with 4,000 to be captured. Other months, like August, you might get 0. There is no guarantee of income in the markets. What there is some months you make more, some months you make less. The way you iron that out is in the month in which you make more, you save it for the month you make less, and that irons it out, and that's what gets you to your 500 to 1,000 a month. But let me show you something else. Our best winning streak was 70 winning trades out of 100. The worst winning streak was 30 winning trades out of 100. Winning streak doesn't matter. I'm going to show you why. The typical maximum loss in a trade was about 50 points or 50 pips. If we were trading £2 a point, which is way too much risk for a beginner, that's 2 times 50, which is £100 loss in any losing trade. But wait, that's too much. Wait for me for 1 second. 2 times 2,250 net pips captured in a month is £4,500 profit in a month. Hang on, I said we only want to be making 500 a month. If we want to be making 500 a month, that's 10% of that, which means we can do 10% of the £2 a point, which means we can do 20 pence a point. When we did this mathematics and saw this with the Pips Predator indicator, we realized, guess what? It's the 20 pence a point, which opens it up to a broader market, because it means people can achieve a reasonable, sensible, non-greedy target of one trade a day, £500 a month, by only risking 20 pence a point. There's no point trying to make 500 a month by risking your entire house. 20 pence a point is a sensible, small risk. And that's why it's all about the risk. It's about protecting that. Okay, it's about protecting that. It is about these numbers. Okay, if you want to download this, I'll show you how. If you want to become my apprentice, because you like what I've said, you like the principles that the trends are going to be more important than just buying and holding, and you need to have that flexibility to buy and hold some and then trade around it to make more money and get those 100% returns. This is what the Pips Predator was generating for us within the fund, and that's why we decided to create what we think is $1 billion business. We're going to IPO this in 2019, so please remember the name, Pips Predator, Alpesh Patel. 2019, we're going to float it either on the US market or the UK market, and we think it's going to be a future Google, because it's like the Google of trading. Google is an algorithm which searches the internet for information. Well, this is an algorithm which searches every currency pair, every stock, and every time frame for information, which is, have we got multiple indicators, multiple time frames showing a trend has started? Okay, that's doing exactly the same as Google. Isn't that $1 billion technology that we've created? And the great thing about this is if you're not awake at 4 in the bloody morning, it doesn't matter, because if the price when you wake up is still near the entry, then you can take that signal because you won't have missed anything. The trend still hasn't happened. Okay, and it's not going to win every single time. Okay, sometimes this does happen, as I showed you earlier. Sometimes that does, of course, happen, as I showed you earlier with some of the other trades where you just get one winning trade after another. But that's not what happens all the time. Okay, what I want is people to trade with an indicator. Without an indicator, it's like these guys. They're picking all of this stuff. Well, guess what? That's hard work, because you're only trying to find, you're not finding enough trades. You're not got enough opportunities. You're not sifting through enough quality. When you're this guy, you can sift through enough quality because it's automated, and that's what an indicator does. It automates. This is how people trade now. They don't trade sitting there looking for head and shoulders patterns and Fibonacci's and Elliott waves and spending hours and hours doing it. What they do is they get a computer, a robot, okay, to sift through it so that they find those trades. And when they're wrong, any losses are small in size, short in duration. Write that down. Small in size, short in duration. That is the critical factor of making money. That when you're wrong, you're able to fail fast. Write that down. Fail fast. It's the truth in entrepreneurship. You want to know how people got rich? They were able to fail fast, and that any losses they had were small in size, short in duration, not just in trading, but in life generally. Okay, and you know how they got rich? Well, when they struck oil, like a trend, they doubled down on it. They didn't just walk away from it. In other words, they did the exact opposite of what loss-making people do in trading and in life. Okay, that's what we're looking for. That's what we're looking for. We're looking to be right 6 or 7 times out of 10, not every time. And we want it to relieve our psychological pressures, which are when we're short and we then need to go long. We got the computer taking the stress, not us. So I asked people, what more do you want more than this? And people said, look, critical factor to success is we don't want to pay for anything every day, every week, every month, or every year. We don't want a subscription to anything, okay? Because that's too expensive. It takes money out of our pocket. I said, what else do you want? Because I thought, if we're going to create a technology company outside of the hedge fund, which the hedge fund's invested in, what else do we want to give people? They said, well, we want a hedge fund manager who's a professionally trained communicator, FCA regulated, who's paid by Bloomberg and the Financial Times, so the biggest brand names, who does academic research, continues evolving his indicators, algorithms. This is a trading algorithm indicator, okay? It's a trading algorithm indicator. Continues developing the technology. We're on version 4. Well, why do you change it? Have you noticed that cryptocurrencies came about? Do you think we just do one thing and then sit on our laurels? No, cryptos came about. Okay, so we had to just tweak things a little bit here and there. We're on version 4. Okay, who's won awards for their trades, as I showed you mine in the Financial Times. Not these fake awards for best trading educator. Okay, who cares about whether you're a bloody trading educator from winning a fake award? You want somebody who's won awards for their analysis. As we tell people who invest in our fund, you want somebody who's won it. The problem people said out there is everybody else is a bloody Ronald McDonald. That's your problem right there. They are a Ronald McDonald. So the questions you have is, can the pips predator, can it make money? Well, I've shown you some examples, there's some more. Is it easy? Yes. You just follow the signals. And I'll show you. Give me 2 minutes. Mark, Simon, Peter, Roderick, give me 2 minutes and I'll show you how to download it. I know you're keen. Can I do it anytime with a day job? Yes, because it was built around people with a day job before and after work. How much does it make? Well, it depends on how much capital you start with. And I say start with $1,000, but start with a demo account with risk capital first. And follow those signals. Depends how many signals you follow. If you don't do anything with it, well, it makes nothing, okay? Does it make life easier? Heck yes. It was built for people around a day job. You know, my day job is not sitting in front of a computer screen. My day, because I get 18-year-olds out of university to do that, my day job is to raise capital, the CEO of an asset management company, from pension funds, flying around to Europe or Singapore or Hong Kong, raising capital. That's what all asset managers do. Are there checklists? I'll give you the same checklist we give trainees in my fund. Okay, I'll give you an example of what some of the trainees do. Some of them like to trade 5-minute charts. I don't recommend 5-minute charts. Euro, dollar, 5-minute bars, 3 hours, 75 pips, 75 times $30 a pip. Why $30 a pip? Why so large? Well, when you're confident and you know that something is just a cookie cutter, it is just a process. This trade's going to win, this one might not win, this one will win, this one might not win. You're just doing a cookie cutter, then you do a higher volume. It's like making sausages. Making money should be like making sausages. It should be a factory of output. Okay, that's how it should be. So yes, you're going to have some bad sausage, you have some good ones. Overall, you've got a net positive expected return. That's what the important thing is. Or Euro-dollar 15-minute bars, 9 hours, 73 pips, including additional position, $73, $30 a pip, $2,190. Dollars. I won't go through all of these. There's too many to go through. Okay, and all of this. Biggest endorsement I ever got was from the chairman of the Chicago Board of Trade. Printed it on the back cover of Financial Times book. Gets to the heart of the matter of trading by clearly elucidating the methodologies of successful trading strategies. Clearly elucidate methodologies of successful trading strategies. If he calls it a successful trading strategy, one thing's for sure, it's a bloody successful trading strategy. This is how I mentor my apprentices. Okay, I give them the software, they license it. I give them a business plan. It is bespoke to them. Okay, they can practice and test on this. Okay, I give them an exam. I give them 2 sets of different courses. I give them the software. I give them access to me one-to-one. I give them a bespoke business plan that they can use as well. I then track their performance because that's what they asked for. They said, we want to track it. Gets better. Okay, I give them not just access to me and the mentoring and a 12-week course, which is for people who want to take their time, but they can do it as whenever they want in their own time, wherever they are in the world, and a 1-month one, which we use for our total beginners. Okay, a 30-day course for total beginners, wherever they are. Okay, they've got lifetime access to it, and we benchmark them with others. But here's the beauty. I give them lifetime access to me until they're profitable. Lifetime. No monthly fees, no weekly fees, no annual fees, lifetime access. You know why? Because if I can't get people profitable, and I'm that confident that I can, then why shouldn't I say, I'll give you a lifetime access to me until you're profitable and access to the software and to the license and everything else. Why? Well, because you're not going to need lifetime access to me because you're going to be profitable. That's the only way to guarantee success. I took a leaf out of my alma mater. I give them daily emails on what I read in case they want to look at them, mentoring emails, the trades that we make each week, and a monthly newsletter, Outlook, all this inside information I've given you today, access to my mentoring website, so they've got all the information I'm giving them, everything that I get, when I'm being Robin Hood and stealing information from Goldman Sachs and everybody else, the courses, the trading man, the article, they get to meet me. I met one just today as well. Signed copies just for trying this software of my 2 most recent books. Signed copies of my 2 most recent books, £50 worth of books, just for trying this. You can keep it. Keep those books just for trying this. All right? Okay, I won't go into all the maths. I'm trying to get people from this to this, this to this. It's as simple as that. I want people to go from this to this. That's what I want people to be psyched about. Guess who I'm seeing tonight? Biku's in town. I'm seeing him. He lives in Dubai. This is what he said. My first ever apprentice. I love the pipspredator. I now spend most of my time trading. I love that as a novice. I know what to trade, when, how much, and can leave the experts to get on with my work. He was my first ever apprentice, would you believe? Years ago. That's how we got this idea. We were just talking. He said, why don't you, if you're just doing it for one person, why don't you license this? I said, well, why should I? There's 2 times. He said, well, you could create $1 billion company out of it. This is my most successful apprentice. Naomi Westall, Newton Investment Management, worked for women as my assistant, manages $10 billion now. This is what I'll do. Signed copies of my 2 most recent books to keep just for trying this. Okay, just for trying, because if you've done me the honor of trying it, it helps get the word out more. I take them in batches of 25 apprentices at a time. Not 25 ever, but in batches of 25. 25 tonight, for instance. Might do another 25 in a month or in 2 months. I'll give you my 30-day guarantee. It's not 7 days you can use it, 14 days, 21, 30 whole days. You've got a whole month in order to make money. And it's 100% money back guarantee, and you get to keep my books anyway. Okay, if you want to become my apprentice for life, and you don't have to pay for anything every day, every week, or every month, and you can start trading straight away, download it in 10 minutes tonight and start trading the DAX as Louise has done tonight. Thank you, Louise. I can see that on the DAX, and has thanked me very much for it. And start profiting tonight if you wish. You've got 30 days in which to do it. It takes 10 minutes to download. I limit it to 25 apprentices because I'm doing the apprenticeship. I'm doing the mentoring. The bigger picture is as I get to 1,000 apprentices through this, and we've got about 500 people who've gone through it, we get the venture capitalists to invest into it. Google Ventures, Amazon Ventures, and SoftBank are the 3 we're talking to. And then we IPO it in 2019. All apprentices get free shares in the IPO as well. So you've got a double whammy. You'll either make money on this or the IPO. We're living in a crazy universe. If you want to be mentored, want to be part of my apprenticeship, and I'm going to do the Q&A now, okay, then do this. Wallstar, thank you very much, you lovely person. I'm delighted you love it, Wallstar. That's what I like to hear.
Wallstar is over the moon. Well, actually, his name's Wayne Putt at hotmail.co.uk. Wayne.Putt. Thank you, Wayne Putt. We love you as well. I think Wayne wants to marry me, actually. He loves me that much. No worries. Calm down, son. Calm down. If you want to be an apprentice, join in 25 at a time. That's the bigger picture. I want people to trend follow. I've given you the stocks that we're buying and holding. Given that I think the market is always going to go through cycles, we know that, and it might even fall down. The reason we're going for the buy and holding is for exactly this reason. Okay. All right. Is exactly for that reason. Is exactly for that reason. That's the reason. That's exactly for that reason. All right. That we want people to be trend following, but it is one in 25 at a time. All right, so that's where you sign up and to join into all of that. That's how you join the apprenticeship, the mentoring. There is no daily fee. There is no monthly fee. I can see some questions coming through. There are no upsells. Okay, we're not here to. The upgrades are free. Thomas, upgrades are free. There are no upsells. Okay, you're not going to have somebody go in. Michelle, you are through, and so is Neil. I can see that that's gone through as well. The reason we want to mentor people is we're building a software which we think's got a global hub to all of this. And what happens is when you go to that page, alpeshpatel.com/here, really important, always look for the green padlock. Okay, green padlock means your data is secure. Nobody can tap into your data. Okay, works on Mac. Yes, it does, Timothy. It does work on Mac. Marcus, it works on PC and Mac. It works on both. Yes, you can get updates as well. Okay. There's no ongoing cost. All the data, everything that you see on screen comes with it. What it's doing is it's telling you, okay, Neil, you can work. Like I said, 15 minutes before and after work is when I want you to look at the indicator. You look through, just to reinforce that point, even with a day job, as most people on this webinar will have, they'll have a day job. You look through all these screens. Okay, you pick one quality trade a day. You do it before and after work, or you do it on Fridays. Do an hour and do 5 trades. You might have seen a signal on this, and this, and you say, right, those are the 5 trades I'm going to place. That's how we do it. Themis, that's perfectly fine. No problem. Will you send me the email? Yes, please, Themis. Just email me again, and I'll make sure that you're on. No problems with that at all. Yeah, Bod, you're the first person who's ever thought of that. I trust myself. I don't know who you are, but thanks, Bod. No worries there. Okay. And then what we discovered is that about 10% of people were giving up in 30 days. They might keep the books, or maybe they were making the money, and then that was it. 10% would give up, 90% continued. It was a phenomenal way for us to handhold and make sure success. Because whenever we're just educating people, just giving a course, giving a webinar, we're getting too many questions from people. They're going, oh, well, how do I do that multiple indicator again? How do I do multiple time frames again? Wallstar, you are welcome. 84 Brook Street is my office. Come anytime. Okay, come and visit. We've got your IP address, so we're more than happy. Okay. Come any time at all. Okay. Wayne Putt, we've got your thank you. No, we've got your address. I'll be happy to send across something over for you nice as well. No worries to you, my friend. Okay. What else have we got? We have got because some people go, okay, well, what else? One thing that's absolutely clear is, yes, you've got a day job, so it's got to be a process. That's what give people a manual with this as well. So it's got to be a process. All right. Tom, how do you pick time frames? Actually, the manual includes all of that. Also includes how to pick a stop loss, all the bits that I've mentioned. Now, you can use that not just with my methodology, but any methodology as well. Okay. Yes, you can use it on spread betting because that doesn't matter. CFD, spread bets, none of that matters. What matters is that you get the signal. How you then use that on the futures trading is entirely up to you. How you use that in the futures trading is entirely up to you. Is it possible to use on daily time frame? Yeah, Neil, you can use it on daily time frame. As I showed you some of the trades earlier on. The thing about the daily time frame is you get relatively few. You're missing a lot of opportunities. That's all I'd say to you. The markets tend to trend quite a bit. Oh, by the way, 6 webinars each Saturday as well. You've got a webinar at 11 a.m. on stop losses, 12 o'clock on entries, 1 o'clock on limit orders, 2 o'clock on stop losses, 3 o'clock on money management, 4 o'clock on adding to winners. So one thing you need to know, Barry, you are through, and I've got you, Ricky, as well. Walter, yes, who wants to marry me? By the looks of it, you are through. Okay, as well. So there's no issues there. Congratulations to you. Right. What we've got is probably what we've got with this is probably the most efficient way to learn. You see, people are trying to do it in a classroom. The problem with classroom is you come home from work, you're in America, we've got a lot of people in Canada, got a lot of people in Australia, Canada, UK is about 70% of people because I'm British. United States, Australia are the two next biggest, UAE, Singapore, Hong Kong, got several in Sweden. Anyway, what we found is because people are in different time zones, they want to learn in different ways. They want to learn at their own pace. Some want to watch videos, they want to watch it all again. So what we did is create a dedicated website for them. Okay. And what we did with the website is that with that dedicated website, and let me just show you, I got 1 or 2 people saying, what's the address again? alpeshpatel.com/here. What we found with the dedicated website is that they could watch the videos if they wanted videos. They could look at the articles if they wanted articles. And we've got an IT team who can install it. It takes 10 minutes. There's also something really useful. You've got the address as well. All right. Here, 84 Brook Street as well. All right. Come and visit me if you're an apprentice. Okay. You get the mentoring as well. Morgan, I'll catch up with the emails. With you. I've got several emails. Sorry, I've been away. So Morgan, I'll catch up with your emails as well. You got a 24/7 phone numbers, and really importantly, LinkedIn. I want all apprentices to join me on there. I want this to be a holistic experience. It's not just a one-off hit and run. I want you to see that I'm the real deal. Go onto LinkedIn. You'll see. I'll introduce you to anybody I know, from the CEO of this bank and that bank and all the rest of it, because I want people to have a success, whether it's change of career, whether it's just looking at learning a new skill, whatever it is. I want it to be more than just, oh yeah, thanks, you came for a 1-day weekend bloody course, which cost you 10 grand and that was it. I want you to be profitable. That's why there isn't a subscription fee. There isn't an upsell. There isn't a ongoing charge. All upgrades, Robert, are free. Sanjeet, you are through. Your order did go through. I'm looking at it as well. Oh, IRA. You had your New Year's Eve close to my office. Good. Where did you have it? Let me know. We're looking for as well. Nicholas, you can sort of self-drive. We're trying to avoid self-driving. It's just that if people plug self-driving in automated driving, let me put it that way. But we can talk about that, Nicholas, offline, about auto doing things. What worries me is you look at some of the crypto volatilities, people forget these things, they go away and they come back and they go, oh, I didn't get that. I want people to be in charge of their trading. And I just think it's a lot better and easier for them, and more responsible for them as well. There's also a MiFID II reason, not to get too technical, not to have it auto, but have you in control. Because the difference between MiFID II and not MiFID II is the degree of user control. Okay, what I'm showing you here is the 12-week course. Over 12 weeks, you get all these little baby bite sizes. Now you can do it over your own lifetime whenever you want. But if, like Nicholas, you've got a day job, you come back to it whenever you want. What we found is this allowed accelerated learning. This is what, through the mentoring questionnaire, which was a bespoke questionnaire, allowed people to do it bit by bit in their own time, but made it bespoke. What we realized is videos are important to accelerated learning. How do you learn to trade? Videos were important so people could see. So they could see over my shoulder and I could look over theirs because they sent me their emails. So we found that emails, them sending in their trades. We found them filling in a questionnaire.
so I could see what their strengths and weaknesses were. And we use Google Forms for this, accelerated their learning. We found also through all of this, what accelerated their learning was when they had trade sheets so they could send me in their trades. We found what else did it was when they had access to a trading community, so they weren't alone, but they could ask questions amongst each other, which is free for the apprentices. And in the trading community, they could ask any questions they wanted, and I would be the one answering it, because the problem with communities is sometimes people just leave you alone to it, and then somebody comes up with the wrong answer. I answer that. So it shows you my weekly trades and monthly ones and all the rest of it and what we're looking at. So that way, we found every single thing. We asked, what will lead to success? We did not want to leave any stone unturned. Some said videos, some said cheat sheets, some said a community, some said email access to you, some said meeting you, some said look, being able to do all this at 3 a.m. Some said being able to email you looking at this, and all the rest of it. And I said, yeah, I'll just message you back what the answer is. Some said just knowing that you're there. Okay, so we wanted to make sure no stone was left unturned. They also said, what would lead to success is, what if we're not that good? What if we're not that good? And I said, well, you know what? You're not paying for anything every day, every week, every month. So you could take as long as you want. IRA, that's really the reason. You've hit the nail on the head. It's really the reason for CFDs over spread bets. Sometimes CFDs have tighter spreads as well. But yeah, hedge funds tend to use, most people don't know this, they tend to use CFDs. They tend not to buy the underlying. Okay. No, Nicholas, it's the same one. Nicholas, it's the same one. It's just a different URL. One explains it in more detail. This is more focused. What I also give for people who are absolute beginners is monthly newsletter updates as well, and my modules. Very structured, this part, very structured. So you've got baby steps and structure. You can start from who trades FX online and why. So if you're a real beginner, module, review sites, test your knowledge, all of these things which people said they wanted. We built this based around what people said led to success. We monitored what got them trading to success, because when we had them in the fund and they were employees, these are the things that made a difference. Module 2, the currency quote, mastering all the jargon, all the rest of it, okay, is what was critical. Knowing when to buy and sell, the top rules of the pros. And this was a more structured approach, because some people say, I want a structured course, but I want to not do it in a weekend or in a hotel. I want to be able to do it in my own time frame. So we made sure we created this, and it's all me doing it. I speak through all of this. It's not somebody else. This is my baby. This is my technology company. I own 100% of it. This is the billion-dollar technology. I think now you might think I'm an idiot calling it a billion-dollar technology with such high ambitions and hopes. Well, it's a British company, and I hope for my sake and flying the flag for the UK, it will do. No, you can execute through there as well if you wish. It's not a problem. What I say, okay, now you can use any broker you want. It's an indicator, but you can use any broker, or you can use the broker here, and you can just hit the buy button there or the sell. Entirely up to you. So you can trade through it, or because some people say, I don't want to trade through whichever brokers you're suggesting. I want to trade through my own. I say, hey, that's fine. Trade through whichever broker you want. I wanted people to have ultimate freedom. I wanted them to have the ability to choose. It was all about choice and freedom. People have different brokers, okay? And you can trade off your cell phone or your iPad. Don't use the indicator on your cell phone or iPad, because otherwise you're going to overtrade. You're going to be obsessed with it like all these people are with their blooming Facebook posts. What I want you to do is use the cell phone and iPad when you're in front of the PC or laptop. Don't worry, I explain all of this in the manual, and then just trade on the phone, so it's like a second screen. What is average gain on Forex trade? Also, can you install on more than one computer? Peter got no problems you licensing it on more than one computer. In other words, yes, you can use it on more than one computer. I'm not here to gouge people and say, oh, no, more than one computer, you got to pay more, and all of this. The average gain, I showed you on the earlier slide, what we found, but there's a big variance, okay? So the average, there's the arithmetic average, which is 2,245 pips, did I say, in a month on average? But the variance was everything from 4,000 on one end, you see. So that was it. And it all depends on how many you do. If you don't do any trades at all, was it Peter? Then you won't have any wins. So that's really important to, and I know it sounds obvious, forgive me if that sounds obvious on that. Peter, it depends on the
the leverage you take, the percentage return. If you do high leverage, you've got 100% return. But the danger with that is you could have a few losing trades. So I normally tell people, try and use the least potential leverage. You see, for any net positive return, if you want to target 100% return, you just change your leverage, your position size, you increase it until you get 100% return. But the problem with getting 100% return, how can I explain this? Let's say you wanted 1,000% return. Well, you just do a ridiculously large position size on one trade. But what would happen? Well, what if that one trade was a bad one? Then you'd lose all the money. Do you see what I'm saying? So the answer to your question is, in any net positive strategy, the percentage return is depending on the leverage you take. So we're targeting 100% return. Just so you know, what I'm saying, over a year, we're looking at 100% return. Now you might say, well, why not 500%? Well, because I think you're taking too much risk. You're doing too large a position size. Because what if you threw tails 5 times in a row and you got 5 losing trades? And I show this in the manual that, would you feel happy being down 20% after 5 trades? As a hedge fund, we'd be out of business if we did that, because our investors, they want money back. So I say 100% return is fine, because you get 5 losing trades, that's fine. So that's the percentage return is the answer that we're targeting, Peter. It's about what you target, not what it can achieve, because it can achieve any target you want because it's net positive return. I hope mathematically that makes sense for you. Oh, Victoria, delighted you're an apprentice. Thank you, Nicholas. More than happy. Oh, wonderful, Nicholas. You're on board. I'm delighted. And I'm going to really handhold and take care of all the apprentices. I should say apprentices, and you'll know this if any of you, the apprentices, are on this and watching, as well as the 6 live webinars you got on the weekends. I really try to do anything and everything you want. If it's not already there and I've not already done it, for instance, I've not created the videos or written the articles, and that's very rare that ever happens. I'll do a video, I'll write an article. You know why? It's no skin off my nose. I love the business of trading. So if I think somebody isn't getting something, it is my business to make sure they get it. Of course it is. Why wouldn't it be my business to make sure somebody gets what I'm trying to teach them? And the other thing about it all is, come and visit me. If you're an apprentice in particular, when I do a BBC or a CNBC or whatever, I'd let my apprentices know when I'm going to be on air. Come and see me at the BBC. We're going to use the profile I've got on air and whatever, just like Richard Branson uses his profile to make sure we promote our algos. Whenever I talk about the markets, as I was here talking about this, I use the algo, I use the pipspredator. I put my neck on the block. This is not just for a private group of people. I put my neck on the block. Victoria, welcome. And I say to them, this is where I think the market's going to go. So it's not just you as a private group where I've got nothing to lose because it's just us. I do it on air. I put my neck on the block on air and say, this is where I think the markets are going, and this is based on my algorithms and everything else. So just so you know, that's the case. And I want to be friends with my apprentices. Okay, I hope at no point in any of this I've come across as arrogant just because I happen to be on TV and all the rest of it. My point is, I want to be on your side, apprentices. I want to get you to profitability. I want to create, I'm not going to be brash and say I want to create millionaire traders, because I don't know, you might be starting with $1,000. If you're starting with $1,000, you're not going to get to being a millionaire in a week, are you? But my point is, I want to create people who want to become fund managers. I'll help you with that. If they just want to earn a side income, 500 to 1,000 a month, I want to help you with that. The whole point with any technology is it should help make your life easier. The reason I'm passionate about it, yes, because I think it's the greatest piece of trading technology there is. I think it's the Google of trading. I think it's an amazing thing. Of course, I'm going to say that. Forgive me for saying it. The reason I'm passionate about it is because it's turned everything around that I do. It's what I do. It is my life. I could not have given this webinar, a year ago? I could not have given this webinar, not just a year ago, about 2 years ago, because the technology didn't exist. It exists now. It exists so that we can get on. Oh, by the way, VAT is only payable if you're in the EU, Timothy. I think you asked, and Barry, and we can send a VAT invoice for those of you buying through your businesses. We can send an invoice because we're VAT registered as a company in any event. Kevin is through. Petra is through as well. Who have I got on the questions? I've answered that one. I've answered that one. Yes, a beginner. It is meant for you. Kelly, it's meant for you as a beginner. Scroll down on my iPad here. it is meant for you, Kelly, as well as a beginner. Actually, most people are beginners as well. Okay, Mark, you are delighted as well. As well. Mark's really excited. Mark, I'm delighted. You're still here. You're still here. Lol. Thanks, Mark. Mark's been stalking me, but I love you, Mark. Mark, I'm married. But thank you. Okay. But thank you. William, I'll send you that on how to do the upgrade. All upgrades are free. Can you put more than one? Yep. Steve, who accepts more than 20 pence a point? I'll send you the list of brokers and the one I'm a brand ambassador of as well. 24 option. They do 7 pence a point actually. What live platform? MT4 is what we're using. Yes, Sophia, we do actually use it for that. Delighted, Sophia. Email me. I know you're on board, so I'm delighted. Thank you, Sophia. No worries. Yes, I haven't actually shown you too many commodities, have I? That's only because I just don't look at commodities that much. I just don't. It's got nothing to do with anything to do with commodities. But yeah, absolutely. I'm trying to find the commodities on here. But yes, oil obviously is a popular one. We used to have silver on here. But yeah, it works on commodities as well. The URL, alpeshpatel.com/here, Jonathan. Does it work on commodities? Let's show you it on commodities. See if I can find, where's that? I think we did have a silver one. Oh, there we go. There we go. ZAG. That's silver. Okay. And there you go. So if you are, but don't forget, yes, you've got commodities. It doesn't matter what you're trading. We're following trends. We're following trends based on the underlying trading psychology of markets moving. Okay. That's the important thing. Okay. And that's what leads to success in the trading. That's what leads to success in the trading. Okay. Now, any other questions? Oh, yes. If I had to summarize it, I put this slide up because this question comes up. I don't want people to be screen slaves. With this, you're not screen slave. It will send you alerts if you want. Don't recommend it because you'll become a screen slave. Instant download. Hedge Fund Manager. Financial Times endorsed. Bloomberg endorsed. That's me. Okay. Oxford University Fellow. That's where we do the research. And I give a lecture on behavioral finance each year as well. There's no repeat or subscription cost because I'm not interested in taking your money. I'm interested in you being profitable, because when you're profitable, the only thing I ask all apprentices is, the only obligation I put on them is, please let the venture capitalists know, the investors in the company, when you're profitable, because we want an honest assessment of showing them how many we've converted, because that shows the valuation of the company. Every one of you who is profitable, we value, is worth the valuation to the company of about $500,000. Alpesh, can we share in some of that? Yes, that's why we're giving free shares in the company for the IPO when the IPO happens, subject to lawyers saying that we can't, but I don't think that's an issue. There's no hotel cost, no travel cost, no screen slavery, one-to-one assistance. Comes from either my assistants if it's IT related, or directly from me if it's anything to do with trading at all. Okay, so that's the thing. All right. Larry, no, you can use any MT4 platform, Larry. Any MT4. Do you need to, we'll download it for you, Lois. Do you need to download MT4 from Broker First? You can pick any broker. We'll show you the ones we like. You don't have to use the broker you use for MT4 to place your trades. Some people might use, for instance, FXCM for MT4 and 24 option to place their trades. It doesn't matter which way you do it. Oh, that's the thing. No, Wig. It's 997 forever. It's a one-off payment. In future, for future people, not for you guys, we want to try and convert it to a model where it's £1,000 a year for the indicator, £1,000 a year for the mentoring. But for the moment, it is 997 one-off fee. You'll never have to pay any more.
Lois, I just want to make sorry, Wig. I just want to make that clear for you. Any more questions? Let me know. William, the top right MACXO, do they relate to current time as opposed to when you buy and sell? Current time, William. So that way, because the reason for current time is so it gives me a good indication where I am on any one trade. Because sometimes you're in an open trade and you want a view, don't you? Let's have a look at Euro Sterling. Okay, we're long on Euro Sterling, but you want to know, okay. Sometimes you might want to take a position early because you see a better trade elsewhere. And you say, hey, listen, this is in profit. Should I take it? Well, it's got 2 red arrows. It's not telling me to get out yet, but should I take it? Okay, because I've just seen a better trade elsewhere. So do you see? That's why I have this. Those arrows indicated there. But also, just so you know, the beauty of this system and why I love it so much is it tells you where to add to winners, where the stop loss is. It tells you for any given position size, okay, what risk you're taking, and it tells you a stop loss, tells you a buy point, and everything else as well. Yeah, sure, Peter. And you can use MT4 from any broker. Like I said, I'm a brand ambassador. It just so happens I'm a brand ambassador for 24 option right there. But you can use any broker you wish. I like them because I know them. I've met the CEO. I met them through Bloomberg. That is the best endorsement for me. Anything from Bloomberg or Financial Times, I trust. Okay, it's as simple as that. Anything from Bloomberg or Financial Times, I trust. It's as simple as that. Simple as that for me. Okay, so I just wanted you guys to know all of that. Any other questions, let me know. Otherwise, I'm going to go to my apprentices. Larry, I mean the symbol data, FX stock, etc. Oh, that I got from 24. But other brokers have different combinations. Up to you what kind of choice you want, what you like. Peter, in a way, the spread doesn't matter if you're not using that broker. I'm just showing you one broker. You can pick any broker you want to trade through. And some have a lot narrower spreads, others have wider spreads. I can inform you on that. So don't worry if that at any point ever gets confusing. We can help with all of that. I can sort of direct you to that as well. Yeah, somebody said, can I walk you through, where's it gone? Lynn said, can I walk you, am I able to walk you through the sign up? Once you go to alpeshpatel.com/here, you can either use PayPal, but you don't need a PayPal account to use PayPal. If you're using American Express, use the PayPal link. You don't need a PayPal account to use PayPal. I know it sounds confusing. It is lifelong mentoring. You don't pay anything for that. I don't know when we're going to increase the fee to £2,000 a year. It is 25 apprentices at a time. I have about 75 in the program at any given time. 500 have gone through it. About out of the 90% that stay on beyond 30 days, 80% are profitable within 3 months. Some are profitable on day one. They're profitable immediately, and so on. Okay. Peter, we can use a broker with a tight spread if that's what you're doing. Not a problem. Thank you, William. I really appreciate it. Once you start filling it in, you should be able to change your location. I've just got a question here from AI or Al. Sorry, from AI. See, Al. Why can't I change my location? Don't try and change your location first. Fill your name in first. And then put in your postcode, and then you should be able to change your location. Sorry about that. It's just a little thing. And if that becomes a problem, then use PayPal, and you should be able to do it as well. But once you start filling it in, it'll let you change your location. So don't worry about that. Exactly. Wig. Thank you, Wig. Yeah, in a way, you're right. I guess if you say 99 months, no, I think, yeah, exactly. Al, good. Hopefully that will, I'll hold that for you, Al. Alvin, thank you. Apologies. I didn't quite get that right. As well. And yes, there's a no quibble money back guarantee. You don't have to send me your trades if you don't want. If you get busy, sometimes people get busy, you know, and that's all fine as well. No, it's for life. Wig, it's membership for life. You've got the license, you have it for life, not for 99 months, for life. Okay, and upgrades for life. Now, should I fall under a bus? Well, we've got a company, we've got a bunch of people who'll do it, but you've got access to the indicator. It sits on your computer, so you've got that. It's yours. So even if I fall under a bus, at least you'll have it anyway. All that would happen if I fall under a bus is, well, I won't be able to mentor you, will I? I'll apologize for that. But I've got no plans to fall under a bus. Touch wood. Okay, Wig. And yes, I just summed that up again for you. Daily newsletter. No, you don't have to pay £50 to open an MT4 trading account, Nicholas, at all. No. You don't have to pay for anything. Was the length of membership? What happens if it is less than 99 months? Do I get a refund to my for instance? No, Wig. It's what happens if it is? No, Wig. I think you want to misunderstand. It's one-off payment for life. A one-off payment for life. Okay, it's a one-off payment for life. Let me just say that again. It is a one-off payment for lifetime access. Just so you know. All right, one-off payment for lifetime access. I hope that makes sense. I can't say it simpler than that. It's a bit like when you buy a TV. You've got a one-off payment. You get the TV for life. Yinka, sorry, the sound's okay at our end. Apologies for that. Guys, if I've got no more questions, apprentices, I'm going to leave it off there. Wig, it's a one-off payment of 997 for life. A million years. Okay? You've got it for a million years. Nicholas, when I click to download trading software platform, step 1, it takes me to open a trading account. Nicholas, don't worry if you're finding any confusion there. That's so you can download MT4. But if you're finding problems with that, I'll do that. So don't worry, I'll do that for you. Thank you, John. I really appreciate when people give me positive feedback because it's very difficult on this. So really appreciate when people give positive feedback. Believe it or not, it's always good to get it, no matter how long you've been, sort of in the industry, speaking to people. It's wonderful. So any positive comments you've got, thank you, would be really much appreciated. Apprentices, non-apprentices, I'll send you an email with all the login details. Nicholas, don't worry. If you've got any problems downloading the platform onto which to install the indicator, we'll do it for you. If it takes you more than 10 minutes, apprentices, listen to this bit. If it takes you more than 10 minutes to download MT4 and install the indicator, we'll do it for you. Don't waste your time if it takes you more than 10 minutes. It shouldn't do, but we'll do it for you, okay? I'm going to send all apprentices an email with access to my private email address, my private traders community, the pipspredator website, the 2 trading courses, the 30-day course, the 12-week course, and all the login details again. Neil, working for Input Mac, place order over my iPhone, but your page. Neil, I'll hold it for you and I'll send you a link to make it easier. So don't worry. Oh, thank you, Lois. That's really nice. I really appreciate that. Let me know who that is in Norway. How nice. I'm trying to think. We do have, I said, we've got some people in Sweden and in Norway and Denmark. I know that. So that's really lovely. That's great. But believe it or not, behind all this brashness, there's an insecure person. And it's always lovely to get comments. So Lois, thank you very much for that. Neil, I'll send you. Great, Neil. I'll send you that in a second. Neil, could you just check your email address that you spelt it correctly? Actually, I think I've got it anyway. No, you have. That's fine. Wig. No, Wig. Sorry, can't do that for you. It is what it is. You got 30 days, not 7, 14, 21. You got 30 days in which to do it. So I hope you like it. It's the way we did it because it's simpler for us. It's simpler for you. It's no nonsense. You pay, you get, job done for you. We mentor you for life. It's the simplicity of it all. Once you start getting into, can I spread it over 2 years? It's like, oh God, when did they start? Who started then? Oh, what have we done? Wait a minute, they're making lots of money. That's not fair. It's all of that. Yeah, no worry, Lois. We can do that for you. No worry. We've got a technical team who are available to do. We've got a live 24/7 phone number as well. And they'll take messages. They even get the messages to me, and I'm always on top of any of the IT. Lois, email me. It's also on the webpage, and it's also at the bottom of the sign-up page. And I'm going to email all of you, including the apprentices, so you'll have multiple ways of getting hold of me. And I'll put you in touch with the IT people if you haven't found it. Okay. So that's fine. Listen, apprentices, thank you very much and really appreciate it. Wig, it's your life. It's for as long as you live.
you can use it for as long as you live. You can use the license. So it's as long as your life, you can use the license. So I hope that explains it, Wig. You can use it for as long as you live. Okay. Thank you very much. And apprentices, if there's anything I've missed, or anybody who's got Q&A, anything that I've missed, I hope I've answered every single promise in the email about every single trade. Oh, people want to see some of the trades. Whoa. Okay, let's go to, I tell you what we're long on, because we just got a signal and my assistants told me this. Oh, come on. Here's the screen. It took about 10 minutes, like I said, to install. Sterling dollar, cable. That signal's just come through. So we're long on cable. You can trade Bitcoin. You can get signals on Bitcoin on this as well. Bitcoin, Ethereum, Dash, Litecoin, and Ripple. Those are the 5. I'll say that again. Bitcoin, Litecoin, Ethereum, Dash. Just those 5, I'm afraid, not the others. We're beta testing on others. I'm keeping, and when we do that, it'll be free. We'll make sure it's all on there for the apprentices. Thank you, Bernie. Really appreciate it. Always, like I said, appreciate good feedback. Occasionally, because it's a webinar, you get people who watch it for 2 hours and then they'll be a bit abusive. Can you believe it? They don't realize we've got their IP addresses, we've got their email addresses, and if you're abusive, there's criminal law against it now on the internet. Some people don't realize that. They think you can be abusive in private. I mean, there's prosecutions. I used to be a barrister. We love doing all that stuff. But yeah, sometimes people do that and they're so stupid. There's people who've lost jobs over being abusive on the internet and they can do it. Anyway, thank you, Benny. I appreciate the comment, my friend. Really appreciate it, especially because, I love doing this. And, I go off the back of people's feedback. When people say this is great. No, Larry, the way the data comes is through the exchanges and then different brokers, depending on whether or not those brokers are offering cryptocurrencies, will take that price data. In the same way, gold prices are set by Gold Exchange, COMEX, okay? And copper prices are set by the London Metal Exchange. And they use that as what's called a reference price, and then they use that on which to place the prices. Just like a stock price is based on the London Stock Exchange price. A broker takes that as a reference price and does it. The same with cryptocurrencies. If your question is which brokers offer cryptos, for instance, 24 Options do cryptocurrencies on MT4, and that's what I've been using as an example here because I like them for that as well. Okay, hope that makes sense. But apprentices, any of these questions you got, Larry, I think you're an apprentice. Any questions you got, let me know after this because I don't want to hold everybody else up. And I'll help you go through it all. I want to thank everybody who's been on to the webinar. Any questions at all, just keep asking me at all. Like I said, we're building a technology company. I want this to be a billion-dollar tech company, okay? And I want people to participate one way or another. Either they're apprentices and they're making capital, or they're apprentices and they own and they get free shares in it is the ambition, or the education was all free. So one way or another, you're all benefiting. And I hope you enjoy and get the passion that I've got out of this. I hope you will also get the same passion and enjoyment out of trading as well. Thank you all. Larry, thank you as well, my friend. Thank you very much. I really appreciate it. Thanks, everyone. Apprentices, I'm going to send you an email. Don't go anywhere. Check your spam as well. Give me about 5 minutes just to have a cup of tea, and I want to check one or two of the trades, make sure my assistant's added to the winners when she shouldn't, because I remember earlier on, I know with, I think it was euro dollar, we did a quite short-term time frame. The reason we do a short time frame sometimes with these trades like euro dollar is because on a webinar it's better to look at, and that trade she would have done the add-on a long time ago. So anyway, thank you, Kay, as well. I want to thank everybody who's been on this webinar. Really appreciate it. And I'm gonna go now. Apprentices, like I said, I'll see you on the other side. And really look forward to increasing your know-how, increasing your ability at profits as well. Thank you all so very much.